picture verbally now. The average daily return for long ES when the VIX is between 20 and 30, currently sitting at 21.06, it's negative 0.04%. Its volatility of daily returns is 1.3%. For the short strangle, the average daily return when the VIX is between 20 and 30 is positive 0.14%. The volatility of those daily returns for the short strangle when the VIX is between 20 and 30 is 1.5%. So Thomas, we're kind of in the zone right now where if you're putting on fresh positions, the history tells us that this isn't the place where you just kind of want to get long. You want to look to this environment in volatility that we have here and see that you can get probabilistically a higher average daily return by looking to sell some vol in a directionally neutral fashion rather than simply taking the heads or tails bet. I'm going to get long here arbitrarily. I'm going to get short here arbitrarily. We are hugging the 1 week moving average. We are sitting in effectively the midpoint of the recent range between, we could say, the September 19th breakout point, the highs that we had later in the month coming here into October. Incidentally, that pushes right up against former resistance turn support near 57.33.5, that September 3rd opening high salvo that we had in this market. So there is a range right now. It's basically 100 points wide, and we're sitting basically at the midpoint of it. I don't know if that means I would want to sell like 3 or 4 DTE short strangles, but seeing as how there is now a consolidation in price and we have this volatility set up with our historical data in our pocket, fresh positions demand directional neutrality, at least in the short term.
Yeah, that's really interesting. I think I saw what you were talking about with Anton. Was that in the cherry picks or was that?
It had been in the cherry picks a while back, yeah. And
okay,
we're actually we're working with the one thing that we have this great back testing tool, by the way. I think Mike Butler's putting together a write up on it today. We've had tremendous feedback thanks to Dr. Data and everyone who's working on it right now. One of the features that I'm talking with Dr. Data about getting is we have this table here of these various strategies: long ES, short strangle. We're going to get them all: iron condor, reverse condor, calendar call rate, and how does each perform in particular windows of time given volatility profiles. And anyone's going to be able to go look back and say, hey, the last time we saw conditions like these, what were the 1 month returns of these strategies? What about the 3 month returns? What if I did 45 in, 21 out, typical tasty way? What does that look like? And so we want to make sure that this is all available. Like, these tools need to be available to everyone. And, we shouldn't wait on the largesse of an Anton Kulikov fleeing from the hurricane to provide us with new slides every once in a while. So we're not going to do that anymore.
So, Chris, I forgot your S&P target for the year. Was it 6,100?
It is now. Well, I'm long the 6,000 call, so at least 6,000. But hey, like if we want to go to 6,100, it's fine by me.
Yeah, no, I think that's kind of spot on. We're in the last quarter here. Some volatility you price in, and then 6,000, 6,100 seems like a fair spot to put it at. A lot of banks over the past few weeks have been raising their S&P targets, so that's been interesting. I think the Fed playing into this, their rate cut chance coming from 50 to 25, and the market is still tolerating that pretty well. Kind of speaks to, have we officially achieved this soft landing? Recession odds, I want to say, have fallen across most indicators that you look at. So I think that bodes well going into the year end. And I want to say 6,100, I'm kind of right around there too.
The head and shoulders pattern is really the only thing that necessitates that kind of measurement. I'm not looking at this from a PE ratio. I think that making year-end predictions, it's a fun exercise, but is it useful per se? I don't know. But we can see how, just based on a triangle measured move, right? If we were to do an extension out of the triangle, get you closer to 6,100, take a conservative left shoulder, head, right shoulder, there's your neckline. That gets you closer to 63. That doesn't have a particular time in mind, but if we're talking about the trend off the recent lows maintained, then we could see ourselves, just if we continue along this path, sometime in December getting up there. Even a recalibration within the trend. If we just hold the lows from last October, right, to the lows that we had here in August, that means by the time we get to the calendar turn, we're basically 5,800. I mean, I don't really foresee 3 months of chop ahead of us where we just bounce around sideways. But you could start to see that if stocks continue to climb, depending upon a various trajectory or speed, gravity kind of just pulls us up in that direction anyhow. So until we see the neckline invalidated, we get a daily close below 57.33.5, at least here in ES. I'm not going to abandon that technical target because technically nothing has changed. And if you're going to trade from a technical perspective, right, you have to have a checklist, and the checklist is still checked. So regardless of the news or the headlines out there, I'm going to maintain that view. The evolution of volatility perhaps informs us about how we should structure that view, whether or not it's the right time to put on that view, the most cost-effective way to express your position. In any event, the NASDAQ here, the August 22nd high, 20,251 and a quarter, we see here on Friday, and again here today, we bumped into it. We have not been able to clear it. We're pausing there once more. Thomas, the NASDAQ has been led higher in recent days by the Mag 7. Meta, NVIDIA have been doing a lot of the heavy lifting, as it were. What do you think about the fact that it's not the NASDAQ that's pulling us to the upside now? The first half of the year was all about the NASDAQ leading the S&P, leading the Russell, leading the Dow Jones. But since July, that role has been reversed. Is it a problem to you that the NASDAQ is no longer showing the kind of leadership that it once did?
I don't think it's a problem. And, a lot of people have talked about this. And that was one of the main criticisms for the rally for the past couple of years, right? A few stocks, or at least, the Mag 7 taking us higher, carrying water for the rest of the market, I guess you could say. So I think the S&P 500 leading, it kind of speaks to more breadth coming in, a little more broadening, more stocks leading, or at least following the path higher. I think that's healthy for the overall market. At the same time, a lot of people play those individual stock names, right? NVIDIA, Tesla, Meta, tons of volume in there. So it's like, if you're not playing that anymore to the bullish side, if you've had to change your strategy, or if you've been playing NASDAQ, do you now go with the S&P 500 and just, do you keep the same strategy, or do you adjust your strategy to these kind of shifts in the market sentiment? But overall, I think it's healthy. I think it's kind of reflective of, as what we just talked about, kind of that softer landing here with the Fed cutting rates now. So yeah, I have to say I kind of like seeing that.
As we look out along the volatility curve, we could see here that it continues to push up. There is a little bit more in the front month than the second month contract right now, which again kind of makes sense. The world seems like it's on fire. The election's a month away. Thomas, VIX up, VXX up, VXV up. Everything is up there. We go to the Russell here today, which is pulling back in a little bit more. This is actually working out quite nicely for me today. Last Thursday, I put on a new iron condor in the Russell because we got back into the zone between the 618 and 50% retracements of the high-low range that we've seen over the past several months. Obviously, having a big up day on Friday when you're looking for markets to stay calm and drift sideways is not fantastic. So a recentering of that move, as it were, works out. There's 39 days to expiration, so we'll see how it goes. But we have the same trade that's been put on so many times in recent months. The iron condor in the Russell is working. And I know the volatility doesn't look that high here. So for the sake of doing this again at the start of the week, we can go to something like RVX, which is the Russell Volatility Index, and it's sitting at 25.41. When we were at these 25.41 levels back in July, for example, let's see where the IVRs were. So we'll go to IWM.IVR. And today that tells us that we have an IVR 40.29. But back on July 17th, when we had the raw volatility where it's sitting right now, the IVRs were 76. Okay. So I care more about the raw vol at the end of the day. The raw vol itself is, on a relative basis, obviously not as high as where it was in August. When we first approached these levels in July, we were sitting near relatively high values because the IVR is a one-year look-back period. The second we break through the 52-week highs, the IVR scale gets reset. So when you see in the Russell right now a 40.2 IVR, You go, okay, yeah, that's creeping back up there. It's not too high. But the same implied vols that you were looking at in July, you would have said, oh, Jesus, at 80 IBR, this is a great place to put on an iron condor, because it is. So I find myself looking at this and saying this is fine. It's directionally neutral. It hedges against my otherwise what some may consider to be a permeable stance on equities. I do have the NASDAQ and the S&P calls that I'm hoping will work out. So if those do, this probably does not. But in the short term, if stocks are struggling because it's this crappy seasonal period of the year in a presidential election window and missiles are flying all over the world now, then maybe we chop and grind in the short term. And while the longer dated calls continue to fester and whittle away with theta decay, at least this is putting something on the board. So we'll see what happens. But I like the volatility setup. I like the range. I like the fact that we're still kind of just chopping around in the very short term, Thomas.
Yeah, I love coming out with you because I maybe seen it in the past, but I didn't know there was a RVX or a Russell Volatility Index. So that's great to see. But I'm not a big Russell trader, but it's great to know.
The 50% mark we were getting close to a few days ago. That was at 2177. And so we were at 2190. Did I really want to wait? We were in the zone. No, we're back in that 618. This is like the kill box, I think. If you're looking to put on the iron condor, if we're in here, this is the optimal price action point because you're as close to the midpoint between the 6-month high-low range as possible. Thomas, we've talked about the Russell. We've talked about NASDAQ, S&P. Do you dislike the Dow as much as I do? Do you care about this? Look at it, trade it?
Yeah, I mean, I think it's good on the radio if you hear Dow up 500 points or whatever, but I don't trade it. When I was getting into futures trading, there was a couple books that, they said trade the Dow futures. But I don't know if I would tell that to someone that is starting to trade index futures.
Not to someone I like.
Yeah, no. I think, just going off 30 stocks, I think it's inherently kind of not the best indicator. It's used for so many different things on like CNBC and stuff, but I'm just, as a tradable product, it's not my favorite.
Understandable. 0.5% so loss across the board here in stocks. Let's turn our attention to the imploding bond market. Friday's non-farm payrolls report was a good one. Headline jobs growth was better than expected. Wages better than expected. The unemployment rate coming into such a degree that the SOM rule is almost untriggered. SOM rule, if the 3-month average of the unemployment rate rises above its lowest point over the past 12 months, historically speaking, that's been a sign that the recession's here every other time. So when we get the 0.53% reading out of the July non-farm payrolls report that came out on August 2nd, people's eyebrows were raised, right? Oh, the recession indicator that is only a few years old. We hadn't used it in real time before because it was first published, I believe, in 2019. We get to August 2nd and we go, oh, yes, here comes the recession trade. We get to the payrolls report that we have for August. That comes out in the first week of September, and the SOM rule increases further to 0.57%. Bonds increasingly on their recession war footing. And then Friday happened. And the SOM rule shrinks back from 0.57% to 0.5%. If we have another month where the unemployment rate stays on hold, you're going to get an untriggering of the SOM rule, which has never happened before. Every other time the SOM rule's been triggered, it continues to grow and grow and grow. Recession arrives, and then it dissipates. We've never not seen it untrigger before the recession comes, is my point. So it untriggering, Tom, can I call you Tom? We would see a total recalibration of how the market's even pricing recession probability, right? We have the reaction on Friday. We see where we're going today. Oil prices are up. This is probably an albatross around the bond market's neck vis-a-vis those inflation expectations filtering through to the long end of the curve. But now we're at 0% chance of a 50 basis point cut in November. I guess I got to ask you, if you're a bond bear here right now, just putting yourself in those shoes, are you betting that the Fed isn't going to cut in November at this point in time?
I don't see the Fed not cutting. If you're a bond bear, I guess I guess it could be like, you playing a tail risk of that and expressing the view through that way. Um, I don't see them holding. I think it would kind of work against their credibility, or they'd see it as a messaging issue, right? So I think we'll get a 25 basis point cut. Um, and the SOM rule, I've seen a lot of misgivings or misunderstandings about it. A lot of people are saying we're in a recession. The SOM rule has been triggered, at least just in casual discussions or Twitter, at least. And you have to know the SOM rule being triggered is just indicating a higher chance for a recession. I mean, like you were saying, but I just want to point that out. That it doesn't actually mean you're in a recession. Um, but yeah, I think bond bulls or bond bears could be playing that angle that there's no cut. And the chances going from a 50 to 25 doesn't necessarily mean that we're going from a 25 to 0. It lends more credibility to that, but it doesn't mean we're there yet. I think you'd have to see a lot of economic strength, like surprises over what we've been seeing until November to get that rate hold.
Right now, this is an incredible shift in expectations here because I just pressed refresh. I realized that when I loaded the CME FedWatch page earlier, I haven't clicked update here in a while, and I have automatic updates on my browser windows. Like you have the Chrome efficiency, it doesn't load stuff in the background unless you click on it. So while this is supposed to update in real time, mine hadn't updated, and it just did, and I watched it change before my eyes. I say all that not because it's a crazy thing that happened here, and I'm really hyping this up way too much. Let's just cut to the point. 13.9% chance of no rate cut now for November. I saw that 0.1% when I last checked this morning. So there is an ongoing shift. We talk about a bond market that sometimes gets too ahead of itself. Back on August 5th, we had 6 cuts priced in with a 73% chance of an emergency 25 basis point rate cut within 1 week. And we were all here saying, like, that's bonds are probably cooked because that's definitely not happening. The credit market's not cracking, so the Fed's not going to step in. This is the other side of that overreaction. We get good jobs data that tells us that the economy isn't going into recession, so all of a sudden the Fed doesn't need a cut. The Federal Reserve has made very clear, and this is perhaps now me being stubborn because I've been on and have had long deltas here in bonds for the past few weeks, thankfully with enough duration so that these moves to the downside haven't been too painful. And that's in part why the trades have been structured with such long duration, to avoid any short-term pain caused by a reflation trade or even something like oil prices popping off. But if we look at where things are situated here moving forward, right, you are looking at a Fed that has told us they want to glide rates lower as inflation gets close to 2%. And more importantly, they think the balances are risks are balanced because every objective measure that they have that talks about the neutral rate of growth or the neutral rate of interest says it's much, much lower than where it is right now. Something like the Taylor rule, for example, which a lot of people were trotting out in the 2010s as a rationale for why the Fed shouldn't leave rates at the zero lower bound. That Taylor rule itself today is telling us that we still need a 50 to 75 basis points more worth of rate cuts to just get back to neutral. So the Fed doesn't want to restrict the policy anymore. It wants a policy that's neutral, and we're still restrictive. So not giving us a cut in November, in my opinion, my reading of the tea leaves, Thomas, would be the Fed telling us they think that inflation's coming back, that they need to have policy restrictive. And in fact, even by not cutting rates, policy is getting less restrictive on its own. This becomes a real problem for the Fed and the market if they don't cut in November. It means that they may have made a mistake by going 50 in September, and it means that they may be completely misreading the whole situation. My last bit of this and the whole key ethos of all of this, as it was the case in 2022 and all of last year and the first half of this year, it doesn't matter if there's a problem that's going on in the economy. The market cares that it thinks the Fed is on the ball. If the Fed's behind the ball, it has no credibility. When it said inflation was transitory and then had a Russian with all these hikes, everyone said the Fed's drunk at the wheel. We can't trust their judgment. The fact that they stayed higher for longer to make sure inflation was really coming down restored the credibility. So if inflation comes back and they have to stop cutting, the credibility goes away. And then bonds, we've been certainly wrong about being long bonds then. And we will have another considerable conversation down the road. But right now, this sucks. No doubt about it. But the duration is built into, the ZBZN trades, for example. There's still 46 days left to expiration. Understandable. Okay with it. We're going to roll it out tomorrow to the 81-day contract. And we're treating the next month forward as the way to go in and the 45 days as out in the very short term, so we don't suffer from convexity of time decay for days like Friday and days like today.
Now, Chris, let me ask you something really quick. As someone who doesn't trade bond futures that often, are you doing ZN just because the liquidity is there? So ZN for, policy moves, and you do ZB for more economic and inflation concerns? Is that how you do it?
Yeah, ZN is just, I guess I really never thought about it in those discrete of terms. When I'm thinking more about inflation and growth, I'm thinking more about the trades within ZB. When I'm thinking about policy, I'm going even further into the curve. It's too bad bond futures aren't as liquid in ZF as they are in ZN or ZB, because the belly of the curve is perhaps the most reactive spot when the Fed is actually shifting rates. Yes, the short end goes down and the long end prices in some things, but the greatest change you'll find is in like the 3, 5s, and 7s. If I'm bullish, I want to go wherever there's the least amount of vol, so it's cheapest to express the view. For retail traders, though, ZN is more approachable than ZB because it's half the overnight buying requirement. And in recent weeks and months, ZN has actually had more volatility than ZB. In fact, today, ZN has an IVR of 45.2 compared to ZB's 39. So it's a smaller contract, more volatility. I mean, I think most retail traders, if they're looking into the bond futures, they should be looking at ZN as the starting point. ZB can be a little unwieldy when it gets directional and you have a very short dated contract.
So with the 10-year auction this Wednesday, do you change anything with your trade going through an auction?
I can't say that I have ever placed a trade based on an auction.
Fair enough. All right.
I read the auction. I read the auctions, and we actually have a great note up on the tastylive website. How to read a Google or ask Jeeves, whatever you do. I'm agnostic to browsers. But look up tastylive, how to read a bond auction, and it goes to the bid-ask spread, stop through on the screws, yada, yada, yada. Those things matter. I look at those on a day-to-day basis. But around the QRA, that becomes particularly important in the wake of a CPI release, right? After non-farm payrolls immediately, you get like a 10-year auction the day after a CPI release. It's a great read through for how people are actually placing bets with that fresh information, as opposed to all of the churn in the secondary market otherwise. But we have a more interesting topic to talk about here. That's what's happening with gold and silver, and I suppose copper. Let's start with copper, because that's a little bit away removed from some of the geopolitics of it all. There was a note that was circulated this weekend by Chinese authorities. I posted it to my Twitter feed this weekend, but from the State Council Information Office, including various people sitting on the National Development and Reform Commission, that they want to clarify to the market what's going on with these stimulus measures. The exact comment here comes from the chief correspondent of the Wall Street Journal. Quote, source in Beijing told me that there are lots of, quote, misunderstandings in the market, unquote, about what China will do next to support growth. Yes, some fiscal measures, quote, in the pipeline, unquote, but nothing as big as some had speculated. Copper is fascinating because it's so closely tied to China. It's obviously had a very big few weeks, in no small part because people are out there shorting it due to the way that the Olympic medals glinted in their eyes on the television screen. That narrative obviously has run its course, and I hope the people on Wall Street Bets learn their lesson. But this is a legitimate issue now, right? If China is going to come out and tell us, oh, folks, you guys and you capitalist pigs and your money speculating on our markets, we're not doing this. It's the same old as it's ever been. That also is a problem for copper. 88.6 IVR right now. Volatility has come in a little bit here. I personally have abandoned the short put spreads that were working out so well and have then since flipped over into the iron condor. I'm playing this a little bit riskier than the simple 6-month range, even though we're pretty close to the midpoint of that range, because I want to make the bet around the Chinese stimulus itself. I don't think that we're going to go back to the stimulus lows here, Thomas. So I'm have on the short put spread set at 425, 435. So give me some reassurance here, one way or the other. Is the China stimulus story real, or is this tweet from the Wall Street Journal's chief correspondent in China something that we should be concerned about if we've been playing CeeLo effectively with Chinese stimulus for the past weeks to try to run up the clock while the market's still having this fantastic momentum?
So, I mean, policymakers in China, I wouldn't take them exactly 100% at their word what they're trying to communicate to the market, right? You've had Chinese stocks go way higher. You've had like if you look at FXI, it's been ripping. The yuan is down pretty low from its recent highs in July. The Fed making its move has made the PBOC's move easier to do. So I don't know if you're long China or long copper or long any proxy asset that goes off China. I don't know if you exactly take the trade off. I think it's actually kind of reassuring that they're pushing back against markets a little bit after such a speculative move. I think what they might want to be communicating, as you said, is like don't speculate too much, because the Chinese, they don't really like a lot of speculation in their markets, right? They don't like that kind of outside influence coming in. So I wouldn't take it as like go short copper. And I don't, obviously the market's not taking it like that either. If you look at silver and gold, they've been hurt by number one, the dollar. If you look at like something like the DXY just had an amazing week. You got the story and yields playing against it. And now you even got, as you said, this 13% chance of a rate hold in November. So that would be, it would take the speculative wins out of precious metals for sure if those odds keep going higher over the next couple of weeks, and they might perhaps do that if we keep on getting that economic data. I think you stay long copper though. I think any selling is going to be bought up. We had a lot of big names. We had like Druckenmiller come out earlier in the summer. Copper sold off. Everyone said Druckenmiller's wrong. His timing might have been a little off, right? And some of these big commodity traders. But the story for copper, the story for any of this green trade, whatever you want to call it, it's quite good going into next year, even into 2026. Copper, there's people calling 5. I can definitely see that. 6 perhaps. I think above that you get a little too optimistic as long as you're not trading off that view per se. But I think it's a good story in copper here. I think you continue to be long. If you want to get long, you wait for a dip. This consolidation, the IV ranks at 88.6. You can do things like iron condors, except HG is a pretty big product, so you got to be aware of that.
Thomas, just circling back to something you said earlier, you said that we could be looking at a category 6 hurricane. I thought that was a facetious reference, but apparently that's something that they're discussing for the Saffir-Simpson scale to bump it up. Maybe it's 175 miles per hour. Maybe it's 192. If it's 175, I just got this alert. Milton is now at 175 mile per hour winds. So if that's category 6, Godspeed to the people on the west coast of Florida. Anton, get out of there, buddy. Hopefully you make it up to Chicago quickly. Let's talk.
I'm imagining Anton running down a runway in like action movie style, hanging on to the door of the plane with the hurricane behind him.
But like with a sandwich in his hand, because...
Oh, yeah. You need the calories to move like that.
You know how Brad Pitt like always is eating in all of his movies? Like I am like 83% sure that Anton, in his contract to work here at tastylive, like he has to eat. Like it's just his thing. Like that's his shtick, and I want that in my contract too. So let's talk about oil here. I bring up the hurricane information because the Gulf Coast of Mexico here, $77.05. So this is obviously working out in one regard. The short put spread is working out quite neatly. The positioning put spread back from September. There's still some time to expiration for that. This was not the anticipated course of action, but nonetheless, if your short put spreads and the price is going up, you're a pretty happy camper. How much further can we go? We've just hit the high that we had in the middle of August here, right? August 12th high, $76.59. We're pretty close to that. You can make the case that we're getting close to the midpoint of the recent 52-week high-low range, which we are. We are actually crossing through there on Friday. We've since traversed there today. I likewise have on another iron condor in here because the volatility is too darn high and we're too close to the center point of the range. So much of this seems geopolitically driven. And I'm reminded of where we were last Tuesday. Last Tuesday morning, oil was at $65.99 a barrel because of economic concerns that were swirling, that China's supply side stimulus efforts wouldn't lead to an explosion in aggregate demand. So why would oil benefit from making credit easier and more widely spread available, as it were? It wouldn't. We only see that oil starts to move when Joe Biden's White House puts out a report picked up by Axios that they were expecting Iran to strike Israel. And sure enough, they did. The missile barrage arrived before Futures Power Hour last Tuesday. Thomas, this is geopolitics driven to a large degree. Taking Iran's 3.4 million barrels per day offline would have huge implications. And we just saw this in August when the threats of taking Libya's 1 million barrels per day offline had huge implications to the market. Oil was up about $5.50 over those 2.5 days. But geopolitics is a fading concern ultimately. So is this the spot to fade it here today? I think you would say no. But we should be watching these headlines. We should be watching the retaliation. And if it is an off-ramp type of retaliation where they strike some things and damage is done, but it's not key infrastructure, so everyone gets to save face, then oil vol probably comes off the board. And I think that's the most important thing to watch the next few days. Forget any Fed speaker. Forget any economic data piece that's coming up, although CPI is obviously worth watching. On April 19th, when Israel responded to Iran on the Ayatollah's birthday, oil vol disappeared faster than anything else. While everything else was going crazy still, oil vol started ticking down, 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 down. And that was the tell that the market was saying this is over. There was no more reason to have all that fear priced into the market. So keep an eye on the oil vol. When that starts to crack, that's when we know the geopolitics of it all is gone.
Yeah, definitely. And I've got an article out on the relationship between crude oil and the OVX. And, of course, the OVX measures oil volatility, but oil volatility, you see it rise usually when prices are going down sharply lower. Here you're seeing it with prices rise. So if you do want to get short premium, if you're brave enough to, carve out a level where you don't think prices are going to rise above, that's potentially a smart play there. And like you said, geopolitics are a fading concern. And 99 out of 100 times they are. And until they're not, we wouldn't want to see that occur because that means, we go into the next significant escalation, which is at this point, a regional war that could spiral out of control, or the regional war that it already kind of is going into a world conflict. So of course the market's looking for two things: that doesn't happen, or that Israel actually does not strike Iran's oil infrastructure. That's 3.4 million barrels a day. Now, the one thing, if they do that, you might see oil prices sell off even if they do that. And that's because OPEC has quite a bit of spare capacity here. In December, they will be rolling back these production cuts. If they had to, they could potentially do that sooner, of course. It takes time to get some capacity online. You could get some online sooner than others, but it's there. So I don't think, I think the market's waiting for something to happen. And like you said, when that volatility disappeared really quick earlier, it's going to happen this time. When volatility drops, it's going to happen quickly. So if you're watching for this trade, you really have to be on your screen watching if you want to capitalize on it.
Thomas, a few weeks ago, you sent me a note on September 4th, 3:05 p.m. Eastern, crude oil's performance after VIX, not crude volatility, but equity market volatility. The VIX goes above 20. That was September 4th here. And you pointed out that the 1 month return for oil prices in post-COVID era was 4.67% higher. So we closed that day at $68.06 a barrel, not $76.23. It's been a little bit more than a month. So if you want to benchmark it to Friday, I'd say that was a pretty darn good call. And I want to thank you for giving me the confidence when I wanted to sell those oil puts at the start of the month because of the positioning, because that's what got me in. And while it was a really crappy first 3 days with being short puts going through September 10th, it ultimately has worked out. And so tip of that to you. And that's a reminder to everyone, when Tom's put something up on the News and Insights blog, this is my commodity quant, right? This is my guy. And this is.
I appreciate that. I haven't won any national math competitions, but yeah,
that's fine. I'm not calling you Terrence Tao just yet, Thomas. Just calm down. All right. Yeah, Yen makes a comeback here, which is perhaps the most surprising thing that I've seen coming out of today. You know, if you told me, okay, the yields are going to be up and oil's going to be soaring, where's yen landing on your bingo card? And I would have said down because, I'm long deep out of the money puts now. We have the Japanese prime minister coming out and saying, yeah, all those things I said about central bank independence, let's just talk. Let's just talk about these rate hikes. Let's have a conversation. And it's pretty clear that the BOJ is now in a position where if they hike rates again, they're all getting fired and they'll be replaced with little toadies that will not hike rates again. So if they want to keep their jobs and their wonderful government pensions, they can't raise rates once more. It's a very fun situation to be in for a currency. Well, not so fun for us. Thomas, I'm embracing the carry trade again. I think the yen is absolutely dead to rights at these levels. I think that we are looking for a move back down to the yearly lows. And I think ways to find opportunities to express that when it's cheap, when vol is low and the price is rallied, time is right. The price is right to do it. Do you have any feelings, strong or weak, like I do, about the yen here?
I have weak feelings that you're right. I think, continuing the downward path is probably more likely than not. They're weak. They're so weak that I'm not trading it though. I traded the yen a few times this year, earlier in the year, did not do good, and I just feel like I haven't had a good finger on the pulse of that market for quite some time now. But of course, I love to watch the yen, what it does in relation to other assets. But I'm not trading it, so I'll leave this one to you.
We'll see how far it goes. We have the euro, the Aussie, the pound all pulling back in today, which is just beautiful because those iron condors that were put on are finally starting to work after a little bit of pain. 32 days to expiration. This is why we wait and we're patient within that 45-day in, 21-day out window. Time is your friend, and you have to let these things, marinate, open up, decant sometimes when you take longer-term horizons. For the euro, this looks like a double top here. And this is perhaps the most concerning thing for markets more broadly speaking. You can go over to the non-tradable but viewable ticker on the platform, $DXY. This is the highest level that we've seen since the 16th of August. Obviously, we're still within the move that we saw on Friday. Friday was the best day that we had since September 22. The dollar looks like it may be bottoming. The euro looks like they're going to be playing catch up with rate cuts over there. We heard from the BOE last week. They're going to start cutting rates a little bit more aggressively as well. Now that the BOJ can't raise rates ever again, I mean, Thomas, the dollar now feels like there's a few things moving in its favor. So don't fade the dollar strength. The momentum has turned. Euro double top in play. The Aussie coming off of multi-month highs, a potential double top there as well. Is this a problem for equity markets in the short term? Perhaps. Perhaps it's a problem for something like gold and silver, which we really just skimmed by here. But several days in a row where the dollar is surging here, and the fact that gold is still chopping around sideways. The fact that you're look to the crypto space, the risk barometers in the market are still moving up. I think there's a lot to be said there. All right, we can talk more about that later because we're going to be back for overtime, maybe last call even as well. The calendar for tomorrow, uninspired, disinterested. We do have some treasury auctions coming up on the books, although much about nothing, perhaps. October 8th, 3-year note auction, that's tomorrow. Do we care about 3-year notes? No. Okay. The big one this week is going to be on Wednesday. 10-year note auction right after CPI. Yes. Let's check in to see what the world's bond market, world bond traders think about our inflation data. We have the 30-year bond auction on Thursday. So those all matter. But tomorrow, 3-year note auction, we don't really trade ZT around here. It doesn't really move ZF. So who cares? Other than that, lots of Fed speeches for tomorrow. If you like Fed speeches, tomorrow's your day in the sun. It's too bad Anton couldn't be here because he is our resident Fed lover. Bowman, Kashkari, Bostic, and Musalem all speaking over the course of the day. And that's really it for the data. There's a consumer credit report, but nothing of interest from the Europe, UK, here in the United States outside of those Fed speeches and bond auctions. Okay, so as we do at every one of these shows, fumbling the words there, we do a brief bit of education. Today we're talking about market products. Head over to tastylive.com, top banner, Learn Beginner Futures, where you can find the coursework put together by the fine folks on the Tasty Live research team. Let's talk about these market products. Due to its diversified nature, the S&P 500 contains, many different companies representing many different industries. It's one of the most widely traded futures contracts in the world. When you're talking about interest rates, we talk ZT, ZF, ZN, ZB, and UB from 2s, 5s, 7s, 10s, 30s, ultras, all the way out the curve. Currencies, there are now 6 products available. Need to update this slide. We just added the Mexican peso earlier this year, 6M. For energies and metals, you have a lot of things to choose from, including copper, heating oil, gasoline futures. Learn more about what tradable products there are. Go to tastylive.com, top banner, Learn Beginner Futures, or click the link here on the bottom of the slide. It will take you there directly. And with that, Thomas, we are done. Thank you for coming in as my co-pilot today. We had a lot to talk about. Hopefully I will see you again soon. Hopefully it's not another month. Next time there's a WASI report, we have to bring you back. And likewise, that's it. We're good. We did it. Hey, we landed the plane. We're going to take a brief break. After 90 seconds, 2 minutes or so, you're going to have Dr. Jim Schultz with From Theory to Practice here on Tasty Live.
So welcome to the Greeks Crash Course. My name is Jim Schultz. I'm going to be leading you through this series, through this 10-episode series, where what we want to do is we want to look at the Greeks that we as tasty traders use most of the time, that we as tasty traders use to put our positions and our portfolios in the best possible spot. Now, of course, this is going to include the first order Greeks that we're all pretty familiar with, but we're also going to dabble into some of the second or third order Greeks that we find to be very, very important. Now, in each episode, we're going to follow the same sequence. We're going to cover 4 different things. First, what is the Greek? Second, how do we primarily use that Greek? And then third, how do we improve our returns with that Greek? And then fourth, how do we decrease our risk with that Greek? So without further ado, let's dive into episode number 1, Delta. Okay, so starting off, what is Delta? Well, what we're going to do is we're going to attack this thing from 2 different angles. We're going to talk about the mathematical angle, the mathematical side of things, and we're also going to talk about the intuitive side of things. So let's start with the mathematical explanation. Well, delta is very simply how an option price will move given a $1 move in the underlying stock price. Now, as options rarely move 1 for 1 with a stock, what a delta does is it allows us to approximate how the option price will change given the stock price change. So, for example, if an option has a delta of 30, that means that the option price is expected to move by 30 cents for every $1 move in the stock. If a delta is 50, then the option price is going to move, 50 cents for every $1 move in the stock. So mathematically, it really is that simple. If you want to reach a bit further down the learning curve and take a look at some deeper level mathematics related to delta, you can look at the Black-Scholes option price model, because delta is the first derivative of the Black-Scholes option pricing model with respect to price change. So it quite literally shows how is an option price going to change when the underlying stock price changes. Okay, but what about the intuitive side of things? Well, given these quantitative foundations, the intuitive side of things is actually quite easy. It just gives us some sense of how are my options, how are my positions in my options portfolio going to move around as stock prices move around. We usually keep it that simple and that clear and that fundamental at Tasty. Here's where things get pretty interesting. This is actually not how we primarily use Delta. We actually use Delta in a couple of other ways, which brings me to my next point. So how do we primarily use Delta? Well, in addition to that textbook definition, there are two other interpretations of Delta. Number one, Delta can be used as an approximate probability gauge. And number two, Delta can also be used as a share equivalent to measure your directional bias or your directional exposure. Now, interestingly, at Tasty Trade, we actually probably use Delta's textbook definition, kind of the standard, default setting of Delta. We probably use that guy the least. Instead, we use Delta as a probability gauge and Delta as a directional bias measurement at different points in time. On trade entry, when we're putting on a brand new position, that's when we lean on the probability aspect of Delta. When we make adjustments to that position, that's when we might use both the probability gauge and the directional bias that Delta provides us. But at the portfolio level, like when we look bird's eye view, 10,000 foot gaze, that's usually when we lean on Delta's ability to give us a measurement of directional bias exclusively. So for example, let's say that I was considering a short put strategy. Hey, quick shout out to my second crash course where we talked about strategy management and we went over short put, so make sure you guys give that a look. But let's say I'm considering a short put strategy that has a delta of 30. I know that the approximate probability from that delta is 30% that that option will expire in the money. Now, I'm a premium seller. I don't want the option to expire in the money. I want the option to expire out of the money, so I have the inverse of that, or a 70% approximately probability of success. This is very, very useful for me at trade entry. Now, let's say I have a position on and the delta is 40. Well, understanding the directional bias, understanding the share equivalent helps me process the fact that this position is going to feel like owning 40 shares of stock, even though the contract is for 100 shares. Conversely, let's say that the delta was 80. Now I know this is going to feel like 80 shares of stock on a 100 share contract. So it's going to feel a whole lot more like the full contract size and the full contract weight. I can gather all of this from the delta alone. Now lastly, let's look at this from an overall portfolio standpoint. Let's say that my portfolio deltas were 200 and those deltas were beta weighted to the SPY. That's going to tell me, that's going to communicate to me that I effectively have what's going to feel like 200 shares of SPY in my overall portfolio. So that gives me kind of a broad market view of the directional exposure that I have with all of my positions in the aggregate. Understanding delta in these different ways, man, this can really help me make the right decision at the right time. Okay, so let's take a look at the return side of things. In the world of options, somebody once said, for every gimme, there's a gotcha. And Delta's relationship with returns, man, this might represent the most classic gimme gotcha exchange that exists in the marketplace. Now, of course, what we're going to cover for the next 30 seconds, 60 seconds, this is not the only way to generate returns as a premium seller. This is not the only way to generate returns from using options. But when we look at Delta's relationship with returns and credits and premiums, this is going to get us off to a good start. Ceteris paribus, all other things being equal, if you want to generate more returns from Delta, one way that you could do that would be to sell bigger Delta options. So you would choose 45 over 35. You would choose 40 over 30. The reason why this will generate higher returns is those 45 Delta options, they're going to have higher premiums than the 35 Delta options. Those 40 Delta options, they're going to have higher premiums than the 30 Delta options. Now, this relationship holds true regardless of whether you're on the call side or the put side. And to push this idea even a little bit further. The reason why this is the case, the reason why we see this relationship is, don't forget, deltas represent probabilities. Deltas represent the probability of expiring in the money. So if I sell a 45 delta option, then I only have a pop of 55%. Whereas if I sell a 35 delta option, I'm going to have a pop of 65%. So if I sell that bigger delta, yes, I'm going to bring in higher credits, more profit potential, the gimme. But I'm also going to have to absorb a lower probability of profit, the gotcha. Okay, so lastly, let's take a look at the risk side of things. Let's start by stating the obvious. The stock market is random. The stock market is unpredictable. Nobody knows where prices are going. Nobody knows which way the market wants to move in a given day or week or month or quarter or year. Understanding this as option traders, as option sellers, it yields a number of advantages to us, two of which don't have anything to do with delta, two of which don't have anything to do with direction. They are Theta and they are Vega, and we'll take a look at those in those episodes. But getting back to the delta side of things, getting back to delta's focus on reducing our risk, here is the most important thing that you need to pull away. Control your size. Whether it's at the individual position level, whether it's the overall portfolio level, the best thing that you can do to control your risk as it relates to delta is to make sure that you are small enough, make sure that your delta is manageable, and make sure that you understand what directional exposure you are exposed to, which, having gone through, the last 5 or 7 or 9 minutes, you are starting to become equipped to do just that. Yes, of course, we all want to have a bias. We all want to play a hunch. We all want to be long or we want to be short, the overall market or a given stock for a certain time period. That's perfectly fine. But you need to understand the market is random. The market is unpredictable. It might not do what you want it to do. So how do you control your risk in a world like that? You do it by staying small. How do you stay small? You stay small by understanding delta and all the reasons that we've talked about today. So thank you guys very much for tuning in today. I am so humbled and I am so appreciative of your time and your attention. If you want to share this with one of your trader buddies, that would be absolutely amazing. Also, please consider saving this episode for future reference when you're trying to, better understand directional bias, probabilities, etc., etc. And when you guys are ready, I will see you in the next episode inside of this Greeks crash course, Theta. We'll see you guys there. Hey, Jim Schultz back with you guys for another episode inside of the Greeks crash course. This is episode number 2, and this guy is going to be all about Theta. Now, next to delta, what we covered in episode number 1, this is probably the Greek that we use the most often at the position level and the portfolio level. So this guy is critically important to your success as a premium selling option trader. Now, we're going to follow the same structure that we did in episode 1. We're going to cover 4 things: what the Greek is, how we can use this Greek to improve our returns, and how we can use this Greek to decrease our risk. So without further ado, let's dive right into episode number 2, Theta. Okay, so what is Theta? Well, let's break this thing down in the same way that we did in episode number 1 with delta. Let's talk about the mathematical side of things, and then let's talk about the intuitive side of things. Mathematically, Theta is actually pretty simple. It simply measures how an option price will change with each passing day. So what you're effectively doing is you are putting a value on the calendar. See, options are very different from stock in a lot of different ways, but one of which is this. Options have a fixed endpoint. Options have an expiration date, and as you get closer and closer and closer to that expiration date, the extrinsic value of the option, ceteris paribus, has to go lower and lower and lower. That's what Theta is measuring. That's what Theta is capturing. This process, this whole idea of extrinsic value going lower as you get closer and closer to expiration, that is more commonly referred to as time decay. Now, for those of you that might want to dig even deeper into the mathematics, it might be helpful to know a couple of things. Number 1, Theta is a first derivative of the Black-Scholes model with respect to time. And number 2, Theta is not a linear function. It is dynamic. It changes from one day to the next based on a myriad of factors, two of which are these. Number one, how much time you have left in the cycle is very important to determining the actual value, the actual, the increments of theta and how they change from one day to the next. But then number two, the moneyness of the option. Out of the money options, in the money options, at the money options. All of these guys decay differently and they possess different amounts of theta. All right, so now that we have the mathematical foundation in place, let's turn to the intuitive side of things. And the intuitive explanation of theta is actually pretty straightforward. Here's a couple of things that you want to understand. Number one, theta is represented in actual dollars. So for example, if you had a theta of 0.03, that would mean that that option is going to decay by 3 cents per share with each passing day. Now remember, every contract is 100 shares. So you could talk about this on a per share basis, 3 cents, or you could talk about this on a per contract basis of $3. Typically, when we communicate with one another as traders, we opt for the latter, referring to a theta of 0.03 as actually 3, or using kind of the whole per contract value of theta in our communication with one another. But then number two, and this might be one of the most important things to understand when it comes to theta, the theta for short options is positive and the theta for long options is negative. Put very simply, this means that the passage of time helps short options. The passage of time hurts long options. All right, so how do we use theta? Well, the biggest benefit of theta, guys, is in its being a non-directional metric in the marketplace. Right, as we talked about back in episode number 1, when we laid down, kind of the basic foundation of Delta, this is an unpredictable market, right? Things happen pretty randomly, so it can be pretty difficult to predict direction. It can be pretty difficult, i.e. impossible, to predict where a stock might be going next. But we can all be pretty sure that tomorrow is Tuesday, or next week is the last week of the month, or whatever the case may be. So this gives us a ton more control in an otherwise unpredictable marketplace. And also, our research has shown through the various management techniques that we apply to all of our positions, that we apply to our entire portfolio, that is way beyond the scope of this episode, or even this entire crash course, that we can expect to keep approximately 25% of our daily theta. So now, with that number in my back pocket, I've got something I can work with, right? I've got something that I can use to build out return projections, to build out, risk tolerance. Go back to the first crash course. Hey, quick shout out to that little ditty that we dropped last September where we talked about portfolio thetas of 0.1%, portfolio thetas of 0.3%, or whatever the case may be. I can use all this to now begin to build a portfolio that's going to make sense to me and my return projections, my return expectations, my risk tolerance, and all of those things. All right, so now what everybody really wants to know, how do I improve my returns with little old theta? Well, what we're going to see here, this is very similar to what we saw in episode 1 with Delta. In fact, you could even make the case this is even simpler than what we saw in episode 1 with Delta. If you want to improve your returns with theta, once you understand that theta effectively represents the value of each passing day, all you have to do is increase the value of each passing day. All you have to do is increase your overall portfolio theta as a premium seller, so now the passage of time becomes more and more valuable to you. That sounds pretty good. But you might be asking, Jim, are there any risks associated with this? Well, I'm really glad you brought that up. All right, so now how do we decrease our risk with theta? Well, here, the old adage, it rings true again. There is no gimme without a corresponding gotcha. And when it comes to theta, things can actually get a little bit slippery. And that's because before we talk about decreasing risk with theta, let's begin by talking about increasing risk with theta. And to do so, I want to start with this important disclaimer. More theta means more risk. Maybe not directly, but indirectly for sure. And here's how. The primary way that you are going to build up theta in your portfolio is through undefined risk strategies like strangles, like short puts, like ratio spreads, like straddles, etc. Vertical spreads, iron condors, butterflies. These are terrific strategies, but they're not going to build up appreciable amounts of theta. Undefined risk positions are going to do that. Okay. If you have more undefined risk positions on, then you are exposed to bigger and bigger swings in P&L. Now, naturally, you can mitigate this by being delta neutral, by keeping your directional bias in check, etc., etc. But it's important to understand that by having more undefined risk positions on, you are exposed to wilder swings. If you are exposed to wilder swings, then you are exposed to more risk. If you are exposed to more risk with Theta, there's your gotcha. So naturally then, if you want to decrease your risk with Theta, what you need to do is target lower Theta amounts at the overall portfolio level, like we talked about in that first crash course. Rather than going for 0.3% or 0.4%, you might want to target 0.1% of total net lake or 0.2% of total net lake. There is no right or wrong answer. This isn't about being right or wrong. This isn't about being better or worse. It truly is about gimmies and gotchas. It truly is about figuring out what makes the most sense for you and understanding that if you want more return, you have to be willing to accept more risk. And if you want to take your risk down with Theta, you have to be willing to accept lower return targets. All right, guys, so we made it. We have reached the end of episode 2 on Theta inside of the Greeks crash course. If you wanted to share this episode with one of your trader friends, that would be amazing. Be sure and save this episode for a future reference. And when you are ready, I will see you inside of episode number 3 of the Greeks crash course, where we are going to cover Vega. We'll see you there. Hey, Jim Schultz back with you guys for another episode of the Greeks Crash Course. And we are now knee deep into this guy, man. This is episode number 3, where we are going to cover Vega. Now, we got to be open. We got to be honest. We got to be transparent here at the outset. When it comes to the Delta, Theta, Vega discussion, Vega is definitely the third wheel of those guys. But it's still an important metric, so it's worthwhile for us to invest a few minutes to better understand how to utilize this guy. And what we're going to do is we're going to follow the same framework that we have followed for the first 2 episodes and that we're going to follow for all the episodes inside of this Greeks crash course. So without further ado, let's dive headfirst into episode number 3, Vega. All right, so what is Vega? Well, what I want to do here is I want to break down Vega the same way that we broke down Delta and we broke down Theta. Let's explain this guy from a mathematical angle and then an intuitive angle. So mathematically, Vega is a first derivative of the Black-Scholes option pricing model. It is the first derivative with respect to volatility. In other words, it's going to show us exactly how a change in volatility will impact the resulting option price. That's it. Pretty simple and pretty straightforward. And from a mathematical standpoint, regarding the math, that's pretty much all we need to know to move right into the intuition. Okay, so intuitively, the conversation regarding Vega is actually going to be very similar to the one that we had regarding Theta. But before we get into the specifics, let's first understand that volatility has a special relationship with option prices that we have to be aware of. When volatility rises, ceteris paribus, option prices will also rise. When volatility falls, option prices will also fall. So now, let's take that idea and let's translate that into long options versus short options. If I'm long an option, I'm going to be positive Vega. What that means intuitively is I want volatility to rise. I want volatility to expand. I want this to happen because that expansion will lift the option price of the option that I bought. This is a positive outcome for me. Conversely, if I'm short options, I'm going to be negative Vega. So I'm actually going to want volatility to fall. I'm actually going to want volatility to contract. I want volatility to contract because that will send the option price lower of the option that I have sold, and I eventually have to buy back. Intuitively, this is basically the extent of how we use Vega and its relationship to individual options. But it's also important to recognize 2 additional things that are noteworthy. Number 1, Vega is higher for at-the-money options relative to in-the-money options or out-of-the-money options, and Vega is also higher for longer-term options relative to shorter-term options. All right, so how do we use Vega? Well, to begin this discussion, it's really helpful to remember that how we process things at the portfolio level is different from how we process things at the position level. And we kind of saw this take shape in episode 1 with Delta and episode 2 with Theta. What's different about the discussion here with Vega is Delta and Theta, we used both of those Greeks on both of the different levels. We used Delta and Theta at the portfolio level and at the position level. When it comes to Vega, we really only look at Vega at the portfolio level, if we look at it at all. And here's what I mean by that. In the early days of Tasty, we paid a lot more attention to portfolio Vega. We tried to optimize our Vega, or we tried to keep it within certain ratios and certain limits relative to other Greeks like Delta or Theta. But as we've grown and we've learned and we've adapted based on our own experiences, based on our own understanding of the markets, based on our own research and our empirical results, what we've come to realize is this: we don't need to actively monitor portfolio Vega anymore. If our portfolio Delta and our portfolio Theta are in line and on target with what we're trying to achieve, then portfolio Vega just naturally takes care of itself. But to bring this whole point, full circle in terms of how we use portfolio Vega at Tasty, it plays much more of a support role than it does a lead role. All right, so how do we use Vega to increase our returns? Well, rather than focus on how Vega increases our returns, I'm actually going to focus on how Vega impacts our returns. Now, I recognize that might be a little bit misleading, but hey guys, we are already committed to this subtitle series inside of this crash course of increasing returns, and there's just no turning back. When it comes to option profitability, it's very important that we all recognize that there are only 3 ways to make money when you buy or sell options: Delta, Theta, or Vega. Okay, now of those 3, Delta, Theta, and Vega, Vega is by far and away the most hidden of those 3. It's never as clear as Delta, it's never as obvious as Theta, but it is always there, and it's always kind of working behind the scenes. All right, now that we understand that, let's move one step forward. The market, just as a whole, is usually in a state of contraction. Volatility contraction. 80 to 85% of the time, the volatility in the marketplace is indeed contracting. Okay, we are option sellers at the core. We are option sellers most of the time. Remember, when I sell an option, I'm negative Vega. What does it mean if I'm negative Vega? It means that I want volatility to go down. I want volatility to contract. So this is definitely going to help my returns in the long run. However, as we're all well aware of now, being 3 episodes into this crash course, every gimme has a gotcha. And that whole volatility contraction business, that's a pretty decent sized gimme. So you might be wondering, Jim, is there an equally sized gotcha just lurking in the shadows? Yes, there is. The market is normally contracting. The market does usually contract, which helps us a lot. There's your gimme. But it doesn't always contract. It's not always just perpetually in this state of volatility decrease. Volatility can increase too. Volatility can expand as well. And sometimes this expansion happens quickly. Sometimes this expansion happens quickly and forcefully. And that situation can put us, premium sellers, short Vega holders, in a bit of a bind. The gotcha. So that brings me to our next section. All right, so how do we reduce our risk exposure with Vega? Well, this one, guys, this is going to be the easiest segment that we've had thus far inside the Greeks crash course. And this is why. You've already done it. You are already in the process of mitigating your risk exposure by way of Vega. And specifically, what I mean is this. If you've been following along with what we're doing, as I've already mentioned just a few minutes ago, if your Delta is in check, as we've talked about in this crash course and previous crash courses, then you are on the right track. If your theta numbers at the portfolio level are in check and on target, like we've talked about in this crash course and previous crash courses, then you are on the right track. If both of these things are already taken care of, you don't have to actively monitor your portfolio Vega numbers at all. They are going to take care of themselves. They are going to naturally mitigate your risk levels by way of delta and theta at the portfolio level. And just like that, guys, we are done with episode number 3 inside of the Greeks Crash Course, all about Vega. Be sure to share this episode with one of your trader friends. Be sure to save it for yourself for future reference. And then whenever you are ready, I will see you inside of episode number 4 of the Greeks Crash Course, Gamma. We'll see you guys there. Hey guys, Jim Schultz back with you guys for the Greeks Crash Course, and we are now into episode number 4 on Gamma. And to be real with you guys, this is where things start to get a little slippery. Like, we've moved beyond the first order Greeks, your deltas, your thetas, your Vegas. We're now going to crack into those second and third order Greeks, kicking things off here with Gamma. All right, so what is Gamma? Well, let's break down the what it is segment into the same 2 parts that we've been using all throughout the crash course to this point. Let's talk about the mathematical side of things, and let's talk about the intuitive side of things. So mathematically, Gamma is fairly straightforward. It is a second derivative of the Black-Scholes option pricing model. It is the second derivative of the Black-Scholes option pricing model, first with respect to price, and then second with respect to price again. So effectively what it tries to measure is the change of a change, just in a general sense. In a more specific sense, it measures how delta changes, because remember guys, delta is the first derivative of the Black-Scholes option pricing model with respect to price. So gamma is the change of delta. Okay, so now that we have a mathematical basis, what about the intuitive side of gamma? Well, this one is going to kind of be a lot to digest, so try to stay with me here for the next couple of minutes. But in just a general sense, if we were to think of like a car that's already moving, that movement of the car is basically measured by 2 different things: the speed of the car and the acceleration of the car. Well, if we take that idea and we translate it back into an options context, to a Greeks context, the delta would be the speed of the car, the gamma would be the acceleration of the car. So it's measuring how the speed changes. It's measuring how the delta changes. All right, so now that we have at least a loose grasp on the intuitive understanding of gamma, here's the next very important element that you want to add to your foundation. The magnitude of gamma is not nearly as important as simply understanding the sign of gamma and all that that entails. Now, I'm going to unpack a lot more behind why this is the case in the next few minutes, but let's begin by building our foundation by understanding the sign of gamma is what really matters. Now, similar to Vega, long options have positive gamma and short options have negative gamma. A pretty simple concept to understand, and it sounds easy enough. But the positive and negative gammas and what they actually mean, what they actually represent, are anything but easy. If you have a long option with positive gamma, what that means, or what that begins to mean, is that your delta is going to change in the same direction as the stock price movement. If you have a short option or negative gamma, that means that your delta is going to change in the opposite direction of the stock price movement. Okay, now that probably doesn't make a ton of sense yet, so let's work through a couple of examples. First off, let's say you had a long call, very simple bullish strategy. This is going to be positive gamma. Here's what that means. If the stock were to rally, what you want to have happen, your deltas will actually increase. If the stock were to go down, what you don't want to have happen, your deltas will actually decrease. In other words, If the strategy works, right, bullish strategy, the stock goes higher, your deltas will strengthen. But if the strategy doesn't work, right, bullish strategy, stock goes lower, your deltas will actually weaken. Now, conversely, let's say you had a short call on. This is going to be a negative gamma position. Here is what that means. If you have a short call on, this is a bearish strategy. Well, what happens if the stock rallies? If the stock rallies, your deltas are actually going to go down. But since this is a bearish strategy with a short call, those deltas are negative. So they're going to become more negative, which is going to make you even more bearish. But what if the stock actually goes down on your short call? This is what you want to have happen, where your deltas are actually going to increase. Or in this case, since it's a negative number, they're going to become less negative, which means you are less bearish. Okay, now those two simple examples, believe it or not, a long call and a short call, they can be extrapolated out to any long option strategy and any short option strategy. So that's the good news, right? The principles that we learned with long calls and short calls in relation to positive gamma and negative gamma are going to be the same for any long option strategy and any short option strategy. Whenever you buy premium, you're going to be positive gamma. Whenever you sell premium, you're going to be negative gamma. Now, as Tasty who focus primarily on selling premium, we are almost always going to be negative gamma. So that means that our directional biases can strengthen, they can weaken, they can flip over from one side to the other where we were bullish, but now maybe we're bearish in a strategy like a strangle because of negative gamma. Now, the last piece to this is remember all the protocols, all the mechanics, all the adjustments, all the defending losers and managing winners that we put in place in the strategy management crash course that we released a couple of months ago. That all starts, that all centers around this idea, this awareness of negative gamma and the consequences and implications of what that means. All right, so what about increasing returns? Well, gamma is a very interesting Greek because there are many traders in the marketplace that actually do try to use gamma to increase their returns through a process that is oftentimes referred to as gamma scalping. Now, the idea behind gamma scalping usually relates to long options, so positive gamma, and it's a situation where a trader tries to capitalize on the times when they are right directionally and they let that positive gamma continue to build up and work in their favor. At Tasty, however, we actually believe wholeheartedly in a market that is random, in a market that is unpredictable. So that's not typically a strategy that we like to employ. We actually prefer to take the other side of that trade in a process that some might call reverse gamma scalping. So rather than try to be right directionally, rather than try to pile on, in those times when we happen to nail a directional move, we actually prefer to lessen the impact of direction and place a greater emphasis on Vega and Theta, these non-directional metrics, these non-directional elements. This is what reverse gamma scalping actually looks like without getting into all the details because that is way beyond the scope of what we're trying to do here. But the most important thing about this section inside of this episode is this. We don't really focus on gamma too much in regards to improving our returns. We focus on gamma in regards to controlling our risk, which brings us to our next point. Okay, so what about decreasing risk with gamma? Well, this is where our approach to gamma, our approach to this Greek, and our proprietary management techniques, this is where these guys really begin to shine. First off, let's make sure that we all understand that undefined risk strategies are the best way forward to consistency. Consistency with results, consistency with profitability, consistency in a number of different ways. It's that pure, unfiltered exposure to the Greeks that's going to allow you to achieve those consistent results. So that would be a gimme, as some might say. Well, you might naturally be wondering, all right, Jim, where's the gotcha? Well, it's right here. When you have undefined risk strategies on, you are naturally exposed to unlimited potential losses. Unlimited potential losses in way of directional moves, unlimited potential losses in way of implied volatility changes. So a pretty sizable gotcha. Now, to mitigate this, we want to start by understanding and recognizing Gamma's natural drift. Gamma moves higher the closer to expiration you get. It doesn't matter what the stock is. It doesn't matter what the strategy is. It doesn't even matter what the specific moneyness of the option is. You know, at the money, out of the money, in the money. This is how Gamma just naturally wants to move. So we combat this, we mitigate this risk by managing all of our undefined risk positions at 21 days to go. Doing this, it puts a natural cap. It puts a natural ceiling on just how high Gamma can really go. And so what this does for us is it allows us to better control our directional risk without having to monitor the exact magnitude of Gamma as we referenced earlier. Not to mention, our research has actually shown a very interesting finding. Most of the big outlier moves, most of the big outlier losses that have occurred in the marketplace in the last 15 years, most of these guys have occurred in the second half of the expiration cycle. That means inside of 21 days to go. Now, you might see that, and at first glance, you might think, oh, that's just a coincidence. But if you stop and think about it a little bit, it makes mathematical sense, because at the end of an option's life, as you get closer and closer to expiration, this is when everything gets heightened. This is when all the Greeks begin to grow in magnitude, including Gamma. So seeing a situation where most of the big losses occur in the second half of the cycle, it actually makes mathematical sense. And we can avoid some of those, at least, by simply managing at 21 days to go. Wow, guys, believe it or not, but we are now at the end of episode 4. Gamma, this guy is over, this guy is done with, this guy's in the rear view mirror. So if you want to do us a favor and share this video with one of your trader friends, that would really help us out. And make sure that you save this episode for future reference. And then when you guys are ready, I will see you in episode number 5, where we are going to talk about the Greek that gets no love, Rho. We'll see you there. Hey, Jim Schultz back with you guys for the Greeks Crash Course. We are now into episode number 5, where we are going to cover the Greek that gets no love, the Greek that gets no respect, Rho. When you got your deltas, you got your thetas, you got your Vegas, you got your gammas, and then you've got lonely little Rho that nobody pays attention to. Well, there's actually a reason for that, and that is why this episode by far is going to be the shortest one inside of the Crash Course. But still, we have to pay it its due. Let's cover it across 4 different dimensions. What the Greek is, how we primarily use it, how we can use it to increase our returns, and how we can use it to reduce our risk. So without further ado, let's dive headfirst into episode number 5 of the Greeks Crash Course, Rho. All right, so what is Rho? Well, let's hit this guy from the same 2 angles that we've been hitting all these Greeks from. Let's cover this guy from the mathematical side, and then let's cover this guy from the intuitive side. So mathematically, Rho is a first derivative of the Black-Scholes model with respect to interest rates. So what it is going to show us is when the risk-free rate in the marketplace changes, how is that going to impact option prices? That's it. All right, so what about the intuitive side of Rho? Well, believe it or not, there's really nothing there. Like, believe it or not, there really is no intuition that we can readily utilize when it comes to Rho. And the reason why is this. You go back to delta, you've got directional bias, you've got probability. You go to theta, you've got the value of each passing day. You go to Vega even, and you have this natural relationship between market volatility and option prices. But then you get to Rho, and none of that is there. Then you get to Rho, and all that just kind of disappears. Like, sure, we could whip up some textbook scenario just for giggles, but that's not going to have any connection to real situations, real trades, and real probabilities. And the reason why brings me into our next section. All right, so how do we use Rho? Well, here is the reason why there is no intuition behind Rho. Because we don't use Rho at Tasty at all. In 5.5 years as a trader and a show host on the network, I have not once logged into my platform thinking, man, I really hope my Rho is in check. Like, man, I got to see if I need to hedge off some of this Rho risk. Like, no, that is not something that ever happens. So it's not something that we have to worry about in the least. Next to Delta, next to Theta, next to Vega, next to Gamma, Rho should command exactly 0% of your attention. Okay, so how do we use Rho to improve our returns? Well, guys, to stick with the theme today, we're not going to worry about using Rho to increase our returns because we're not going to worry about Rho at all. Now, naturally, you might be thinking, Jim, that's not enough, man. I need a little bit more from you. I came to your video today hoping to be enlightened behind Rho and this Greek and how I could use this guy to make me a better trader, so you got to give me a little bit more than that. All right. We are general practitioner retail traders, right? We are trading a myriad of products across all different markets. We're using strategies here, we're using strategies there. If we were focused exclusively, like 100% on a fixed income portfolio, only trading your TLTs, only trading your ZBs, only trading your ZNs, then maybe we should focus on Rho a little bit more. But for us, as kind of these overarching kind of, jack of all trades traders, it just doesn't make a lot of sense. So what about Rho and decreasing risk? Well, if you've made it this far in the video, if you haven't clicked off yet, then you already know what I'm going to say. For us, this is a non-event. But to push a little bit further, to go beyond your TLTs and your ZBs and your ZNs and your fixed income portfolios, the reason why this doesn't matter to us is because any changes to interest rates or any anticipated changes to interest rates, they're going to be so small. They're going to be so tiny that they are effectively inconsequential. Now, if this were the 70s, right back when Tom was in his early 30s and mortgage rates were, 12% or 15% or whatever they were, then that's a totally different environment. And if we ever get back to that state, then I will come back and I will update this video forthwith. But for right now, in the world that we live in, this low interest rate environment that we've been in for quite some time, that we are in right now, and that we will likely be in indefinitely moving out into the future, it just doesn't make any sense to pay a ton of attention to Rho. Now, some of you, maybe all of you, are likely wondering, Jim, why would you even bother to make this video about Rho when you basically just deflected for 5 straight minutes? Like, why even go through the process of putting this in the crash course? I'll give you one word: completeness. As you learn about the world of options, if you're brand new to the world of options, man, my heart goes out to you guys that are just starting out. You are diving headfirst into the deep end of the pool, and you may not even realize it. You are going to be inundated with information. You are going to be bombarded and blasted with ideas and concepts and strategies and this and that. And sooner or later, this little guy Rho is going to show up on your doorstep. Sooner or later, you're going to learn about or read about or hear about this guy Rho, and you're going to wonder, hey, do I need to focus on this? Like, do I need to spend any attention learning about this? Do I need to invest in figuring out all the things there is or are to figure out in regards to Rho? Like, is this going to make me a better trader? And the answer is no. These 5 minutes, even if they've been the first 5 minutes that you've spent on this Greek, they need to be the last 5 minutes that you spend on this Greek until further notice. All right, so you guys made it through episode 5 of the Greeks Crash Course, even given the non-event that it was. If you want to share this episode with one of your trader friends who is also learning about the world of options, that would be amazing. If you want to save this episode for a future reference, that would also be a pretty good idea. And when you guys are ready, I will see you in episode number 6, where things are going to get a little crazy, where we're going to talk about charm. We'll see you guys there. Hey, Jim Schultz back with y'all for episode number 6 of the Greeks Crash Course. In this guy, we are going to cover charm. Now, I'm going to try not to sensationalize this guy too much. Like, I don't want to lead you guys astray with hyperbole, but these next 8 minutes, they might completely change the way that you view trading. Specifically, your strike selection. Charm really is a total game changer. Now, all right, let's unpack charm in the same way that we've unpacked all the Greeks to this point. Let's do this guy across 4 different dimensions. What the Greek is, how we primarily use the Greek, how it impacts returns, and how it impacts risks. Now, all right, without further ado, let's dive right in to episode number 6 of the Greeks Crash Course, charm. All right, so what is charm? Well, let's answer that question in the same way that we've already answered that question with the previous 5 Greeks. Let's do it mathematically, and then let's do it intuitively. So mathematically, charm is another second derivative of the Black-Scholes option pricing model. It's the same as gamma in that regard. Gamma was also a second derivative of the Black-Scholes option pricing model. Now with gamma, we differentiated the model with respect to price and then again with respect to price. What charm does is it shares delta as that first layer, if you will, but then it differentiates the model with respect to time. So the first differentiation is with respect to price. The second differentiation is with respect to time. So what charm effectively measures is how does delta itself change over time. Okay, so that's the mathematical side of charm. But what about the intuitive side of charm? Well, this is where the magical properties of this Greek really begin to shine. All right, so charm measures how delta changes over time. But if we push that a little bit further, if we explore that a little bit more deeply, here's what we're going to find. Out of the money options and in the money options typically have stronger charms, whereas at the money options have weaker charms. Now here's what that means. If I have an out-of-the-money strategy, then those deltas are going to decay more quickly. Those deltas are going to move towards 0 more quickly. Whereas if I have an in-the-money strategy, those deltas are going to strengthen more quickly. Those deltas are going to move towards 100 more quickly because they have stronger charms on the out-of-the-money side, on the in-the-money side. At the money options typically have weaker charms. They cling on to their deltas for a longer period of time. Those deltas don't decay like they might if they were out of the money or strengthen like they might if they were in the money. Okay, if I'm a premium seller, those out of the money delta decays, now I'm really interested because lower delta options typically carry what? Lower extrinsic values. So as the deltas move down because of charm, the extrinsic values are going to move down because of charm. And now as a premium seller, I've got something that I can work with. So how do we use charm? Well, to be honest, charm, even with all its incredibleness, is not as utilized as some of the other Greeks that we might use on a fairly regular basis, like your deltas and your thetas and your Vegas. And that makes sense because with delta, with theta, with Vega, with even gamma, there's a lot more of a tangible impact on those Greeks, whereas charm is kind of something that's working more in the backdrop. It's kind of something that's working more in the background, but still, understanding its existence, understanding its impact, it can allow you to better screen through your strategies, to better filter through your strategies so that you can select strikes, so that you can select strategies and you can understand the gimmies and the gotchas of those guys so you end up with something that is customized for the risk return profile that you yourself are trying to achieve based on your risk tolerance, your return projections, your experience level, etc. So charm can be a very valuable thing in understanding kind of this customization process. All right, so how can we use charm to improve our returns? Well, charm's relationship with returns is going to very much be what we've already outlined. You move further out of the money with your strike selection, the deltas on those strikes decay more quickly. Because the deltas on those strikes decay more quickly, the extrinsic value on those strikes, on those options, decays more quickly. And as a result, you are left achieving faster relative returns. For example, if you sell a 10 delta put, that's going to decay a lot more quickly than a 20 delta put, ceteris paribus. You sell a 20 delta strangle, that's going to decay more quickly than a 30 delta strangle, ceteris paribus. This is a positive thing. This is a good thing. This is a gimme, if you will. But before you go out selling 3 delta strangles to maximize your charm because, hey, Jim told me so, let's make sure we understand the risks. Let's make sure we explore the trade-off. Let's make sure we understand the gotcha that's right around the corner. Okay, so what about charm's relationship with risk? Well, to be honest, it's not as obvious as it might be with some of the other higher order Greeks like color and like Vama, two of the guys that we're going to see in the next 2 episodes of the Greeks Crash Course. But still, we do know this. If you go further out of the money in an effort to maximize your charm, you are going to have less risk on a per contract basis. The problem is this. Those lower delta strikes, those further out of the money options, they're going to have lower premiums. So what are you very likely going to do? What are you very likely going to consider at least? Adding more contracts, upping your trade size to give the trade, to give the position more economic significance. In doing so, you will be taking on more risk. You will be taking on more risk that you might not even realize that you are taking on, i.e. episode number 8 of this crash course when we take a look at Vama. So the most important thing to pull away right now is there's something there. There's something powerful that's there with charm. But we don't want to just go hog wild selling these 3 delta strangles until we take some time to understand those higher order Greeks, until we take some time to understand these next level gotchas that are absolutely there. And just like that, guys, we are done with episode 6. The second half of the Greeks Crash Course is now fully underway. If you wanted to share this episode with one of your trader friends, that would be terrific. If you want to save this episode for future reference for yourself, that's also probably not a bad idea. And when you are ready, I will see you in episode number 7, where we are going to talk about color. I'll see you there. Hey, Jim Schultz back with you guys for the Greeks Crash Course. We are now heading into the stretch run as we are into episode number 7 of the Greeks Crash Course, where we are going to cover another higher order Greek, color. Now, color is another one of those guys that it doesn't really get the press time. It doesn't really get the time in the spotlight that some of the other Greeks get. But as we're going to see here today, it is critically important to what we do. Let's follow the same sequence that we have followed for all the Greeks up to this point. Let's talk about what color is. Let's talk about how we use color. Then let's talk about color and return. And lastly, let's talk about color and risk. So without further ado, let's dive right into episode number 7, color. So what is color? Guys, let's not reinvent the wheel here. Let's cover this thing mathematically, then let's cover it intuitively. So mathematically, color is another derivative of the Black-Scholes option pricing model, but this time it's not a first derivative. It's not even a second derivative. Color is a third derivative. So we're going to go down to a brand new layer of the onion here today. Specifically, color is a derivative of the Black-Scholes option pricing model, first with respect to price, second with respect to price, and then third with respect to time. So it's price, price, time. Now, you might remember that there's another Greek that we've already covered, i.e. gamma, that is price, then price. So if you think about color, it's essentially the derivative of gamma with respect to time. Okay, so there's the math. But what does that actually mean? Like, how can we actually use that? Well, here we go. Color measures how gamma changes as time passes. So in a sense, it's very similar to theta, or very similar to charm, because theta measures how option prices change as time passes. Charm measures how delta values change as time passes. And color simply measures gamma as the variable in question. How does it change as time passes? And here is the most important part, the most important thing to the whole operation, that is color. The mathematical nature of this Greek shows us the following. As options get closer and closer to expiration, as options march closer and closer to that third Friday in expiration month, here is what we know. Gammas get more potent. Gammas get stronger. It doesn't matter if they're positive. It doesn't matter if they're negative. Does this ring a bell? It should. If it doesn't, that's okay. Just hang with me for the next few minutes and it's going to be ringing loud and clear. Okay, so how do we use color? Well, it's very similar to the other higher order Greek that we just covered in the last episode of the Greek Crash Course when we looked at charm. Color, it's not really something that we actively measure inside of our portfolios, at least not consciously. Like we don't open up our platform wondering how our portfolio's color is doing, looking to measure or monitor a position's color. That's not really how we use this Greek. Now, interestingly though, as I kind of snuck in that little consciously on y'all a couple of seconds ago, we do use this all the time. We lean on the spirit of this Greek on a pretty regular basis. Now, we call it something else. Like it goes by a different name, but we are using color all along, and we'll come back to this in just a couple of minutes. Okay, so what about color's impact on returns? Well, for us, this is basically going to be a non-event. Not like a row non-event. There's a little bit more to it than that, but it's going to be a non-event nevertheless. And the reason why is this. Remember, the base of color is gamma. How do we view gamma? How do we trade gamma? It's kind of a trick question. We don't trade gamma at tastylive. Remember, back in episode number 4, when we looked at gamma directly, we talked about gamma scalping. We talked about how some traders like to piggyback off of exploding gamma late in an expiration cycle to nail those directional moves, to really maximize their returns in the times when they're able to get the directional moves correct. We don't do that. If anything, we do the opposite, right? We reverse gamma scalp. So when it comes to color's impact on returns, it's the same as gamma's impact on returns. We're not using gamma to maximize returns. We're using gamma to minimize risk. So we're not going to use color to maximize returns. We're going to use color to minimize risk, which brings us to our final section today. Okay, so what about color's impact on risk? Well, if you haven't figured it out yet, here is what we've been hinting at for the last couple of minutes. Color shows us how gamma changes over time. Color shows us that gamma gets stronger over time. In other words, color is gamma risk. Einhorn is Finkel, and Finkel is Einhorn. So in the end, we might not be actively looking at color, but we use it every single time we adjust a position at 21 days to go. Right? We might not be derivating the Black-Scholes option pricing model, once and then twice and then thrice to see what comes out, but we are using color every single time we close a position early so that we don't get too close to expiration Friday. That, my friends, is all because of color. All right, so you made it to the end of episode 7 inside of the Greeks Crash Course, where you are now a color expert. If you want to share this episode with one of your trader friends, that would help us out a ton. If you want to save this for yourself for a future reference, that's probably also a pretty good idea. And when you are ready, I will see you inside of episode 8, where we are going to cover Vama and things are going to start to come together. We'll see you guys there. Hey, Jim Schultz back with you guys for the Greeks Crash Course, and we are now into episode number 8, where we are going to cover a surefire crowd pleaser, the life of every party, Vama. Do you guys remember how a couple of episodes back when we talked about charm, I said, hey, y'all might want to wait before you start selling those low delta strategies to maximize your charm? Well, the reason why is what you're about to learn with Vama. Okay, so what is Vama? Well, let's do this the only way that we know how, mathematically and intuitively. So mathematically, Vama is another higher order Greek, but it's going to be a little bit of a downtick from what we saw in episode 7 with color, which was a third derivative. Vama is actually in the same boat as charm or gamma, where it is only a second order derivative. And what it measures is it measures the change of Vega when volatility changes. So remember that Vega measures the change of option prices when volatility changes. Vama measures the change of Vega itself when implied volatility changes. Okay, so what about the intuitive side of Vama? Well, to make things a little bit easier, Vama actually shares the same relationship with options that Vega did. Remember, when you're long options, you are positive Vega. Well, when you are long options, you are also positive Vama. When you're short options, you are negative Vega. When you're short options, you are negative Vama. But that positive negativeness to Vama really only depends on which side of the market you're on. The most important thing for you to pull away from Vama is that it is a positive function. Now, what does that mean in English? It's actually not too difficult to understand. Ceteris paribus, if implied volatility expands, then Vega is going to expand because Vama is a positive function. Ceteris paribus, if implied volatility contracts, then Vega is going to contract because Vama is a positive function. Now, does this mean that all Vamas are created equally? No, absolutely not, as we are going to see in the next couple of minutes. So how do we use Vama? As you've maybe noticed to this point, with charm and then color and now here Vama, these higher order Greeks, they're not usually front and center on our radars. We don't typically use these guys super actively. But if you dig a little bit deeper, here's what you will find. All of the mechanics, all of the protocols, all of the things that we do every single day, yes, we built these things from experience. Yes, we built these things from empirical research. But all along, there's been mathematics that have been driving the train. There's been mathematics that have been the foundation of what we do. And with Vama, we're going to see the exact same thing in the next 2.5 minutes. So how do we use Vama to improve our returns? Well, you know what's interesting about these higher order Greeks, at least the way that we view them and use them, very oftentimes they either end up helping you on the return side or the risk side, not usually both. Like if we go back to charm, right, that was more of a return metric. If we go back to color, just in the most recent episode, that was more of a risk metric. We're going to see the same thing here with Vama. It's also going to be a risk metric. And the reason why that is the case is because Vama, by definition, measures how changes in implied volatility and the speed of those changes are going to impact us. Now, naturally, there is going to be a return element to Vama. Like there is going to be a role that Vama plays in determining our returns because Vega impacts our returns through implied volatility, which implied volatility, of course, is one of the ways that we make or lose money as option traders. But we're not super interested or concerned with the return side of Vama. And the reason why is this. Remember, Vama gives us insight into the speed of change of implied volatility. Vama gives us insight into the risks that we have that are associated with the speed of change in implied volatility. In our game, when it comes to fast movements, when it comes to quick changes in the marketplace, we are more concerned with that on the risk side of the equation, not the return side of the equation. We're not super interested in making money very quickly. That's not our game. Instead, we want to use Vama as a risk metric to help shield us from the big outlier losses, to help protect us from these big outlier moves. So Vama, in our eyes, is very much more of a risk metric. So that brings us to our final section. Okay, so what about Vama and risk? Well, again, as premium sellers, right, it's always going to be these big outlier moves that we need to navigate in order to be successful. And so Vama is going to help us do that. It doesn't really impact us too much on the return side, but it can play a big role on the risk side, and here's how. First off, I think it maybe goes without saying, but just in case, we much prefer lower Vama. This is because lower Vamas allow us to better control and mitigate and contain the speed of those changes in implied volatility. Okay, secondly, Vama tends to peak right around the 5 to 10 delta options. So remember, Vama is always a positive function, but there are layers, there are levels to the magnitude of Vama across the different strikes, across the different deltas. Okay, lastly, because Vama peaks for these lower delta options, this is why we typically don't prefer to sell these lower delta options, even though the charm is super high, even though the charm can be maximized at the 5 delta or the 7 delta or even like the 9 or 10 delta. We would much prefer to sneak into the 16 or 20 delta options with much lower Vama and still plenty of charm that we can capture. And just like that, episode 8 is in the books on Vama. That is it. That is all there is to it. If you wanted to share this video with one of your trader friends, that would be phenomenal. If you want to save this for future reference for yourself, that's also probably not a bad idea. And when you are ready, I will see you in the penultimate episode, episode number 9, where we are going to cover Vana. We'll see you there. Hey, Jim Schultz back with you guys for episode number 9 of the Greeks Crash Course. And in this guy, we are going to cover another one of our higher order Greeks, Vana. This guy's going to be similar to, your charms, your colors, your Vamas. And so hang tight, buckle up, because things might get a little bumpy for these next few minutes. Okay, so what is Vana? Well, guys, we're 9 episodes in at this point. Like, you know what's coming next. We're going to do this mathematically. We're going to do this intuitively. So mathematically, Vana is another higher order Greek. It is a second order Greek of the Black-Scholes option pricing model. And what it shows us is, how does delta change when implied volatility changes? How do changes in volatility impact delta? So in a lot of ways, it's similar to charm, because remember, charm showed us how delta was impacted over time. So here, Vana's going to show us how is delta impacted when volatility changes. So it just gives us another unique perspective of this directional metric that we use all the time, which is delta. Okay, so what about the intuitive side of the explanation? Well, a lot of times when you break things down mathematically and then intuitively, the intuitive explanation is oftentimes easier to understand than the mathematical explanation. Well, that is not necessarily the case here with Vana, and here's why. If we view things from the long side of the option contract only, here is where we want to start. Long calls have positive Vana. Long puts have negative Vana. Now, here's what that means. If implied volatility rises, it's going to send the deltas on a long call higher, positive Vana. If implied volatility rises, it's going to send the deltas on a long put lower, negative Vana. Now, on the surface, it might look like those are two different things, but they're really the same thing. And here's why. Okay, long calls, positive Vana. Long puts, negative Vana. Let's start with the long calls. I have a long call, implied volatility spikes. The deltas on that long call are also going to move higher because of the positive Vana. This is because greater implied volatility, that literally means greater fluctuations in the marketplace. If there are greater fluctuations in the marketplace, there is now a greater likelihood that that long call might expire in the money. Do you remember how back in episode number 1, we talked about delta, and we talked about how we can use delta to gauge the approximate probability of the option expiring in the money? That's really helpful here to help us understand Vana's impact. I have a long call with 20 deltas, IV spikes, it might move to 30 deltas. I have a long call with 35 deltas, IV spikes, it might move to 45 deltas. Now, similarly, Long puts basically follow the same logic chain. Long puts have negative Vana, but here's how it works. I have a long put that has negative 20 deltas. Implied volatility spikes, the negative Vana is going to send those deltas down to minus 30. Or I have a long put at minus 35 deltas. Implied volatility spikes, the negative Vana is going to send that delta down to minus 45. So mathematically, my delta has decreased, but magnitudinally, the likelihood that my put expires in the money, that has grown. And that's the most important part of Vana that we want to understand right now. Now, naturally, you might be asking, Jim, you're focusing on the long side. What about us as premium sellers? What about the short side? Well, we'll come back to that in a couple of minutes. Okay, so how do we use Vana? Well, you guys probably know what I'm going to say here. Very similar to the other higher order Greeks, like your charms, like your Vamas, like your colors, like your speeds that we're going to see in the final episode of the Greeks Crash Course. This is not something that we actively monitor. Like, we don't have Vana hedges just waiting at the ready to go off if things get crazy. Our Vana kind of gets reconciled through all the other things that we do, through all the frontline activities that we deploy and all the protocols that we follow. And so understanding what Vana is doing behind the scenes is extremely important to understanding what you've signed up for, all the gimmies and all the gotchas. But in terms of actively monitoring Vana, it's not really something that we need to do, as you guys are going to see in about 45 seconds or so. Okay, so what about Vana and increasing returns? Well, to answer that question, let's now complete the discussion that we started a few minutes ago when we were looking at the long-only side of the option contract. Long calls have positive Vana, but short puts also have positive Vana. And the reason why that works out as such is the following. Puts naturally have negative Vana. But if you step in and sell that put, then you then become positive Vana. And the way this works is the same way it works when you multiply two negative numbers together. You multiply two negative numbers together, it brings you back to a positive number. So you take a naturally negative Vana'd put and you sell that put, and you actually end up with positive Vana. So now that we know that short puts are long Vana, here's how this impacts returns. Short puts are naturally going to be three things. They're going to be long delta, they're going to be short Vega, and now that we understand it, they're going to be long Vana. If you catch a move in your favor, if you catch a bullish move on a short put position, that is very likely going to lead to very, very quick profits. And here's how. You're long delta, the stock moves higher, you're going to make some money. You're short Vega and the stock moves higher, that very likely also means that volatility is contracting. You're going to make some money. But now we know that you are also long Vana. That long Vana is going to cause your deltas to shrink on that short put position, from 20 to 10 or from 30 to 20. But that delta decrease, it could help to contribute to sucking out the premium from the option in a similar way as to what we saw with Charm. So that is a pretty big gimme when it comes to the return side of Vana. But not so fast, because our old pal Gotcha is right around the corner. Okay, so what about Vana and risk reduction? Well, to better understand, or to best understand this angle of this Greek, let's make sure that we all understand something. We much prefer short puts as a standalone strategy over short calls as a standalone strategy. The main reason why is quite simple. The market wants to go higher over time. So consistently selling calls, week after week, cycle after cycle, year after year is just not a great strategy. So as a result, we are naturally going to be, most of the time, net long Vana in our portfolios. Does this have some risk associated with it? Yes, it does. And not so much because of Vana's impact in isolation per se. It's actually more of a compounding effect that Vana can have alongside the other Greeks, the other higher order Greeks. So to illustrate this, let's suppose that my go-to strategy was selling 5 delta puts and holding them to expiration. Let's work through the charm impact, the Vama impact, the color impact, and now the Vana impact of that position. First off, your charm at 5 deltas, we already know it's going to be super strong, right? It's going to be great. Stock goes higher, stock even goes nowhere. That's going to be terrific. That's going to be a great outcome for you. We don't have to worry about that. Okay. Problem is, your Vama at 5 deltas, it's going to be the Greeks crash course that I had to record. I did a couple of those, probably not a bad idea. And when you are ready, I will see you in the final episode of the Greeks crash course, where we're going to bring this whole thing home and tie it off with a bow and talk about speed. I'll see you guys there.
Hello, everybody. Well, what a day. Okay. For those of you who use Slope, there's a subset of you that do. It has been the worst technical day in 20 years. That's why I don't trust computers. I've been mixed up with these things since 1979. I've written literally dozens of books about programming and using computers. I am a longtime computer dude, but sometimes you just have trouble. And we have had trouble deluxe. It's one of those days I'm glad not to be a brokerage. It'd be a lot worse. So I'm sorry, we're working on it very hard. It's complex stuff. And the good news is that we do not have anything to fear about AI taking over the world, because computers are broken and they're held together by band-aids. Take it from someone who's been mixed up in this for a while. You do not want to see how the sausage is made. This stuff barely works. Okay, so we have nothing to fear from the robots and the AI ever. Having said that, the one thing that's been keeping my spirits buoyed in the face of all these dreadful technical woes is all the red on the screen. Even earlier today, when the market was pretty strong and had been climbing, my stocks were really weak, which is heartening, especially since China had yet another mega rally. And I kid you not, what we've seen over the past couple of weeks is the equivalent of the Dow going up 18,000 points between now and the end of the month. 18,000 points between now and the end of the month. This is not a glitch. I just want to repeat it because it's so absurd. And the cool thing is that even in the face of FXI up 3% and having gone up 40% in just a few days, it's like, I'm looking at them now, JD down, PDD down, YUMC down, all of them red, even with FXI blasting higher. So it's like, cool, because this FXI rally ain't gonna last. This is not just gonna keep climbing. It's gonna pause, people are gonna freak, and they're gonna sell with increasing fervor. And I'm already in position, and these suckers are already falling. So they're gonna fall all the faster. So it ain't just them. It's been a good day overall. As the red slathered all over, it's like somebody doused me in ketchup. So that's what I like. And because of the aforementioned technical hellhole I've been in, I'm being a lazy chartist, and we're going to look at a couple of ETFs, but on the whole, we're going to walk through my bear pin, which is all my short setups, a lot of which I'm already in, and some I'm not. I'll mention why, but I'm going to be. I work hard, but this is lazy for me to do that, because it's been quite the day, and tomorrow's probably going to be quite the day too. I already know that. So let's just dive in together and look at what's going on in the wonderful world of stock charts. Here's the spider, big old red bar there. Ain't nothing real changed though. About 13 days just sticking around in this tight little range. Earnings are beginning on Friday in earnest, and next week they really start cooking. So finally, we will have a period of respite from worrying about what tie color Jerome Powell is wearing, and instead look at good old-fashioned corporate data to see what's out there. So maybe that'll get us out of our stupor. As I said earlier, FXI continues to rage, and I mean rage. The last time it was, everyone hated it a month ago, and it started kind of getting some little higher head of steam, getting exciting, and then Chairman Winnie the Pooh unleashed the bazooka and all kinds of stimulus and rate drops and encouragement and threats of torture, and like it blasted higher. So everything flourishing in China, including today. So I didn't even think about China a month ago. And now I'm like the Hang Seng Index. I'm completely, I know like 6:30 p.m. PST. I know when it opens. I've become an expert in Hang Seng Index now. So yeah, that has become the market to follow. Today, and I've been a little distracted to pay attention to the news, but I heard something about NVIDIA's AI Day, which I suppose is where the excitement today has come in with semiconductors, with NVIDIA in particular. NVIDIA has broken out above its triangle, which is a bullish sign for NVIDIA and maybe for semiconductors in general, maybe for tech stocks in general. But NVIDIA has cracked open from that. This is trend line anchored to the lifetime high, way back June 20, and we burst above it here thanks to, I suppose, well-received event in NVIDIA land. But what we're really going to do, and I've got 10 minutes to do it, so I'll go to a brisk pace, is thumb through the 25, count them, 25 components of my bear pin. Some I love more than others, but they all deserve some kind of place here. I will mention, by the way, because I haven't had time to really fine-tune this, one of the former members of my bear pin was, in fact, NVIDIA. So it's really 24, because having violated that line, I didn't have a position in it, but it doesn't even merit membership in the bear pin anymore. You're fired because it's crossed above that line. So here we go. AMD, beginning with this one. And as we go through these, I'll mouse over. You've got good eyes, right? I'll just mouse over the what I consider a stop loss level, the level above which I would probably kick it out of the bear pin, or at least get out of position. I'm not in position on all these, and I won't bore you with which one I'm in and out. I'm in, out of these 24, I'm in 14 of them, but we'll just thumb them through. And if I'm a little icy toward any of them, I'll mention that at least. But here's AMD, like so. There's a nice price gap on that. Here's Amazon. Okay, can't help myself. I am in this one. I'll just say it because, just to mention. But we got kind of scary close to this line on Friday, but we did not cross it. And we've got an island reversal pattern. Well, not quite. Let's be honest, chartists. We don't quite have that. The reason that is because this low is just a little bit lower than today's high. So we're going to be very, very ethical and say that the low here is 183.60. Today's high is also 183.60. I don't know. Let's get our textbooks out. Maybe that is an island reversal gap since this is the exact match. We'll say yes. I think it qualifies. So usually like a little bit of sunshine between those two, but it's exactly the same. So what's that among friends? We'll just call it an island reversal gap today. So that's good. APA, energy's been very strong of late, but we're getting very close to a gap on this one, like right so. So that's APA Corporation. ARM Holdings, this has had a green day, but we've got a bit of a shooting star here. So I am in position on this one, and I'm pleased to see, because as I started to harp on it, I've been very distracted today. I'm pleased to see this not only is a shooting star, but today's high didn't even match the stop loss level, which is anchored right to this high here. So there was a lot of excitement, I suppose, from NVIDIA bleeding out into ARM, but it didn't have enough to cross over the finish line. So this is still looking good. Cleveland Cliffs down a little bit, and you've seen this one many times. And this one is under that very richly drawn rounded top, and it's a beauty. And almost all these are January puts. I think I've got one weird March one out there. In this instance, it's probably not enough time. But my philosophy on this is that the election, I think, is sort of the kind of the seminal inflection point of this whole thing. And I can't really see the point of like, well, no, not January. I'll get February or April or something like that. The whole world could be different on November 6th. So I just, January's enough for me. Dell, I'm not on this one. And it's probably one of my not quite as favorite ones out of this group, but it's still not bad. And you can see the resistance lines on that one. Next up is DraftKings, DKNG, which is a little bit of a sloppy pattern, but it was sloppy here too, right back here. So this is an analog In other words, the shape really echoes and reflects the shape that had taken place before. And I'm not in this one, but we've got a nice reversal today. We basically undid all that jump from last week. General Motors, GM, not very exciting, but I'm still in this one, and it's just kind of hanging out right now. But that's I got in at a good price on that one. Alphabet had some news today. Alphabet started off quite strong. There was a ruling from a court today that said, "Hey boys, you got to open up your app store to competition," and so the market didn't look too favorably on that. Weirdly, Alphabet was sort of strong early today, maybe because they knew that a ruling was forthcoming and they were thinking it would be up, would be positive. I don't know. I mean, I briefly considered getting out of Google based on that strength today, but luckily I was too distracted to do anything about it, and that's a good thing because we reversed hard on this. So we've undone last week's up move on that as well. Goldman Sachs, way up at the tippity top of that very long channel. Halliburton, also energy related, and also I think prone to some slippage after this big rally in crude. JD, I mentioned this one earlier. This is one of my 3 Chinese bearish positions. We've got hopefully a little hanging man on that one, on that candlestick, but you can see how swiftly and explosively this has moved. Eli Lilly, this one, look at the gap close on that, really nice. Right like so. So it looks like it could be to the penny, just about. I think that's to the penny. That's a beautiful, beautiful gap close on Eli Lilly. Here's a good one today. Lumen Technologies, the biggest top in the West. This is a giant top. We're down over 7% on this one. This is a real favorite. So that's terrific. Netflix, I got into this one on Friday, and we're having a nice down day on this one. It's down over $18. Not much of a pattern to it. I mean, Lumen is like God's own pattern. This is just like, it's too high. So I have no real rationale for this except it's high. But we're getting a nice down move on that. Although it doesn't translate too much into the put value because, a lot of that volatility is already built in, but I'll take it. Still profitable. Nike's down again. Nice new slippage on this, over 2% on NKE. NVIDIA, talked about. That's been kicked out of the club. Here's a new one. I don't think we've talked about this before, but I just stumbled on it this weekend. Novo Nordisk. Nice head and shoulders on this. It's not perfect. I'm a bit of a purist on these charts. I prefer the right shoulder being lower than the left shoulder. It's not, but it's still a pretty good top. And we've got a nice clean neckline on this. So I just got in this morning on NVO. So that is a new pattern I don't think we've ever looked at here. Occidental, another lovely potential energy short. I'm not in that one. I am in this PDD. And even early today when the Chinese market was going absolutely berserk, this was still red, God bless it. And we're below a major broken trend line. So that's looking super. Shopify, mushed up against that broken long-term trend line. Like the look of that one too. This is the only energy short I'm in right here, Schlumberger, the only one, and we're gonna adjust that just a skosh like so. But yeah, we got a little bit above. I get alerted when those are crossed, but in this case, being a little bit indulgent with it because a couple of pennies above that line I can live with. I still like all that overhead supply, but that's my only energy short, as I said. Here's Unity, symbol U, and very clean, complex head and shoulder on this one. We're reversing away from that. A couple more. We're almost done. Here's UPS. This is more of a long-term play. I think it could take months for this one to really work its way out. So I'm not in this one. And finally, and I am in this, and this is the last one, here's Yum China, which has these really overly red tops drawn in. But you can see here that in short order, we moved from the 20s down to about 50. So we just about doubled in price in just a few weeks' time. But we came right up against a price gap there. And I think that's probably cooked at this point. So just to put a nice bow on things, again, slopers, bless you for your patience and your understanding. We're trying our best and we're going to get out of these woods. Don't you worry. Done this long enough to know. And as for the rest of you, these are interesting times. A lot of good setups, as you can see. Earnings start to heat up on Friday, and also Thursday morning we get the CPI, so that should shake things up a little bit. So thank you for your patience and your interest, and I will see you here tomorrow. Come server or no server, I'll be here. Bye-bye.
If you missed the live show, here's our cherry on top weekly recap.
Oh, we got casual size here today.
Look at you looking like a marshmallow peep.
Looking like a little pumpkin latte or something like that. Pumpkin spice latte.
Looking like a coconut cream. Yeah.
Did something today, never done. I don't know if you guys still play Wordle. Got it in one. My first guess. Never had that happen.
Hold it.
Wow,
Stop.
Women.
I play Wordle every day. I have a streak
Me
going.
too.
The entire year of 2024, I haven't missed once.
He doesn't give a about
You
other
really-
people who haven't played.
Yeah.
If you haven't played by 9:36 in the morning, then you ain't playing all day.
That's the word you use?
Yeah, it's a good one.
That word
Oh,
stinks.
you're a little hurt ass right now. Okay.
Hold it.
He's never done it. He's been playing for almost 10 months straight. He's never got it in one.
I've been playing for
You
2
rarely
years.
Play.
Steam?
Yeah, that's my first word.
You've been using
guess.
Steam for the whole year.
For a couple years.
Because he's a steamer.
He doesn't listen. I start talking, his ears just turn off. Who do you listen to less, me or the missus?
No.
Oh, don't answer that.
No leaves changing. No leaves changing.
He's got a big
for foliage
weekend.
I've already got multiple.
See, I told you.
It's too early.
Well, it's also no rain. I guess you need a lot of rain to really get the... No rain?
Gonna be dry. That's right. That sexy individual in my left. That's right. That's him, my friend and yours, Mr. Scott Sheridan from the Scott Sheridan Studios and Tasty Trade.
Okay, I'm done for the day. You just call me sexy. That worked for me.
My dad gets excited when it's foliage weekend for Tom. You know,
Is that this
but
weekend?
that's where is all the sexy Tom.
Wait, that's this weekend?
Yeah.
Oof.
Yeah. It's like a Reddit offering. You know what I mean? Like, you have such good anticipation for it. It rarely comes true, but yet this time he performs.
I've heard that the colors are not going to be great this year due to the lack of rain.
Don't worry. He's dyeing his own foliage different colors, so she'll have something to look at.
Ooh, very trendy of you.
Okay.
Don't worry, this is the one time she'll go out in the rain just to get out of the room.
Over under on cherry pies.
Depends how many we can fit in the car.
Ant 3 this time, please.
Are you going to do some reconnaissance on your way up north? Like, are you going to visit other coffee shops?
I do like to stop it on the way up there. It's a long drive. Like stop, stretch a little bit, you know.
Stop and stretch.
Yeah, look out, people of Sheboygan. There's going to be an old man bending over. Get the full scoop by checking out the archives at tastylive.com.
The delta of paper is equal to the partial derivative of rock with respect to rock, paper, scissors. If you think like a trader, we've got your back. Tasty Trade. Join the club, genius.
Dear Braden, big thanks to you and the nerds for the wonderful tech support. Of course I back everything up to cloud, because I'm 60 years old and I know what a cloud is. Yours truly, Larry.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
No, your office is right near a different. You're like closer to the.
Near what?
Whatever.
This is English. You should watch him read.
From the smart mouths at Tasty Live.
Now, don't screw up. You're the weakest link here.
You guys introduce yourselves.
I'm Tony Batista. He's Tom Sosnoff. You didn't know that? I don't have any idea why you watch.
I'm Tony Batista. He's Tom Sosnoff.
41, you got it.
See that? We knew it. Pretty good. Baseball field.
Baseball game.
It was a wonderful evening.
It was a warm summer day, 1982.
It was around
82, 83, I don't know, sometime around there.
Yeah, 83.
83, let's say.
It was 83. I remember because I was dating somebody else at that time.
1983. Yes. It was a wonderful.
No, we were playing. We played softball on the same team. 12-inch.
With gloves, because we were hand models at the time.
Yes. I played third base. Tony played right field.
You've been dying to say that, haven't you?
We took him. He was a charity case.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Ring the alarm, hey, ring the alarm, boys. Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Tomas, we are back, my friend. You know what that means. Time for a little bit more Tasty Live with the closing bell. Sadnov, let me just start off as saying, as foretold, E-mini S&P is down 57.
Yeah, I don't think you as foretold that. But if you had, if you weren't like off lollygagging around and doing whatever it is you do on Sunday nights and you had tuned into our show, you would have seen last night that Ilya Spivak and myself went against the grain with the SPOOs up last night and called for us to be down in underneath that 5750 level on our way to 5700 this week, which I think.
Yeah, well, okay, well that very well may be when the markets are basically half open at night. But when the markets were open and we were down slightly and volatility was expanding, I'll put volatility up there for everybody right now, up another $2.15, trading near its highs, and it was expanding while we were on the show. I said to you, Saz, what do you think of this market? And you mumbled some bull crap. And I said, listen, I'll tell you what I think. We're going to be lower today. Volatility is just too strong. We cannot discount that. And you said to me, yeah, well, I don't know.
Yeah, we'll have to go to the tape. I don't have any recollection of that whatsoever.
Oh, my God. NASDAQ down 260 and change. You know, I hope the team cuts this up and then he does that thing where I explain what you said and then they play what you said and it's exactly what you said and then they say what I said and I'm exactly right.
Yeah. I don't think we have the technology for that anymore.
Russell down 26. Volatility, as I just pointed out, up 205. Bonds down 20 ticks, 121.11. Bitcoin hanging in there at 63,000 and change. That's the most stable, non-volatile currency we have. Oil, on the other hand, big 4% move to the upside, 77.33. Gold down $5, not much going on there. Silver down 43 cents, down a little over 1%. Sadnov, even the S&Ps have traded less than 1 million cars going into this 50, 60 point sell-off. Kind of. Does anybody care?
I'm a little surprised that the S&P volume isn't higher, especially because we're just into October and I thought there'd be a little bit more volume right here. So yeah, I am surprised by the S&P volume. I'm also kind of surprised by the extremely low, well, I shouldn't say extremely low, but a little bit less than I thought on the bond volume. The note volume was not bad today. I thought there'd be more volatility in the bonds. So I got a little bit long bonds today. It didn't work out. Got a little bit long crude oil too. It didn't work out. We're a little bit short.
A little bit long crude oil?
I'm sorry, a little bit short crude oil. Didn't work out.
Because usually if something goes up 4%,
no,
you get long it, you usually do good. Because I covered my short oil before the market opened today. I made a couple of dollars on my, just $100.
No. I want to get shorter.
In 48 hours, I take a couple of dollars.
No, I want to get shorter here. I think it's a good play for quite some time. So I'm going to be staying short oil. I'm going to be staying.
Look at this week oil's had. I mean, from the low to mid 60s to the high to mid 70s. I mean, that's some move in oil.
Yep. Yeah. There's been some. That's been the oil and bonds have been the two biggest movers. The S&Ps have been just. Well, there were a lot of strong stocks today that confused me a little bit. Nvidia probably.
A lot of them being Chinese stocks too.
Yeah. Also, some of the tech stocks were pretty strong. Nvidia stayed
Biden's up
strong.
4.
Yeah.
But I'm sorry, Nvidia's up 3. Yeah, you're right. Vaba's up 2 and change. Taiwanese semiconductor up 220. That tech stock Lulu up $1.75.
Yep. But Netflix finally broke 700, which is good. And
down almost $20 on Netflix.
yeah. Couple things to note here.
Meta down 10. Your beloved Tesla down 8.5. Microsoft, that big dog, down 6.
If you wanted to do a VIX one day, this is the first time we've had I don't believe there's any economic numbers tomorrow. Is that correct?
Oh, you mean, let me put this in English for everybody. You're saying let's look at the VIX one day as possibly putting on a trade in SPX because it's 15 and change on the VIX one day. You're not going to trade the VIX one day.
Yeah, I was going to trade the S&P one day, but what I was looking at is the VIX one day is over 15 with no economic numbers. I believe that is...
You are correct. They don't come out until Thursday or Friday.
Right. So I believe that is the first time we had a 19 close.
But I don't want to step on your new boyfriend Ilya's toes and stuff like that. Maybe he could tell you when they come out. You know, your Sunday night partner.
I think this is the first time we've had a non-economic number 15 close in the VIX one day in quite some time. So I think I'm going to go into the SPX and do something tonight. Playing by the rules.
Oh, you are bored. Look at you. Let's
waiting
go.
to the end of the day. Looking
46% monthly implied IV. Very nice. That's about rank.
Let's see. The expected move for tomorrow in the one day, let's call it $40. Is that fair?
Yeah, 37. Say 40 works for me.
VIX one day, let's go $40. 56.90 to let's say, well, let's go $50 above. 57.40. Let's go $50 below. 56.40. 56.40. 56.40. 57.40.
945 is mid price.
Yeah, I'll move the puts down a little bit just to be safer. And so $50 on the call side, $60 on the put side.
To give yourself a little bit of short delta. I don't know about safer. If we go higher, it's not any safer.
Yeah, we'll see. And it's going to trade around 820. What do you think? Got a chance to get it filled here?
You doing the 56.30s? Yeah, you got a chance if you bribe somebody. Maybe better chance for you to get filled at 8:15 or 8:20. Where'd you get filled?
820.
8:20.
All you need is a little down tick every once in a while.
That's all it takes.
820. Just give a little. I don't usually trade the SPX one day or the SPX 0 day unless the VIX one day is up over 15. And the VIX one day right now is
15 and change.
15 and change, 1544. Somebody wrote us today and said, why doesn't SKU update during the day? It's a SIBO index, and it doesn't update. I think it only updates once a day, right? Is that right?
Yeah, I think so.
Yeah.
I think so.
So it's at 156. I would be a lot more concerned right now if the SKU was at 32.
106?
32.
Yeah, right. Right.
Yeah, we did a study last week. We don't crash from 156. We crash from 132. So that would be a lot more concerns. But I do think the VIX one day up 138 today is pretty big without an economic number. And the VIX futures today,
strong all day.
Oof, strong like bull. VIX futures up 215. That's 10% today. Wow, that's a big move.
Yeah, on top of a 10% move, just about a week or so ago when we went from 18 to almost 20. So yeah, it's been a big move for volatility.
Yes.
I see a little SPX broker wing butterfly for option trades today, every Tuesday and Thursday. Lucky for you, tomorrow seems to be Tuesday, and maybe an oil trade. since I've become such a good commodity trader these days.
Yeah.
I love your vote of confidence.
Yeah. Big time vote of confidence. Let's see what else we got going on here today that I thought jumped off my screen because I was.
My peeps from Sunday night who hinge on every word you say would like to know what you thought about oil and bonds last night. They get your ES made.
I already told you what I thought about oil and bonds. I love bonds here for a trade. I've just been selling puts today, the 120 puts. I'm up to about 138. They're like 142, right in that range. And I'm offering some right now, 143 and 144. Nothing done yet. But I like those here, and I also don't like crude oil. But the crude oil trade, I'm all defined risk on because I don't really love, it has some crazy upside if something nutty goes on somewhere in the world.
It does have a lot of upside skew too. And in oil, the IV rank is under 80. It was over 100 just 2 days ago.
Yeah, the crazy thing is that we have some short strangles on in there, and those things got crushed. They got crushed. But
really?
That's the only thing that really worked with those short strangles. Those short strangles in there, oh my God. Yeah, they
you mean volatility got crushed, not your position.
Yeah, no, the volatility got crushed. If you sold 115 to 125 IV rank in crude oil, you took almost like 60 or 70 cents out of that with crude oil.
Yes.
Not doing what you wanted it to do. But
moving too far outside the expected move for sure.
Yeah. I forgot there was one other stock today that had crazy high implied volatility rank, but I don't remember what it was. Do you remember what it was you talked about this morning? I can't remember what it was off the top of my head right now.
Pepsi has earnings, but that wasn't what I was talking about.
No, it wasn't Pepsi.
Oh, Baidu and Baba on those.
Oh yeah, Baidu and Baba. Yeah. Yeah.
They have huge IV rankings, huge implied volatility. Hey, Sadna, before we run out of time, I don't want to forget. I picked up your uranium. Where would you like me to drop it off for you?
Oh yeah. Well, you have a pickup truck, so I figured you could be the one that goes and gets the uranium.
Right, I got the uranium for you. Where would you like me to drop it off?
My nuclear reactor, please take it to my nuclear reactor, and I could use that.
Don't think I don't have my peeps that watch you on Sunday too. We watch.
Looking
eyes on you.
Looking at my screen and trying to determine, if there were any other kind of really interesting outliers today. I mentioned Netflix only because the stock hasn't had a downtick, and to be fair, Meta hasn't had a downtick too until today as the first kind of day. And looking at the rest of the screen to see if there's anything that kind of looks, and I'm not going to count Costco or anything, but this is the first day when I guess I kind of feel like there's not a lot of days when you get the VIX up. What is it up? The actual VIX up 373 or something today?
Yeah, VIX, sure.
Yeah, VIX. That's a pretty big jump. 2294. And let's see.
An 11% move in the VIX futures going into the end of the day. You only got another 12, 13 minutes at the end of the day. I mean, this would probably be one of the biggest percentage moving closes that we've had. Not dollar amount, but percentage move. This is a pretty significant move.
On a day when the S&P volume is nothing, and that's the weirdest part, is to see this kind of move in the VIX. It should put a little bit of a, maybe, does that put the fear of God in anybody?
I think it should. I mean, I think if you don't respect volatility when the market's not really going down and volatility is going higher, you like to flirt with danger, not me.
Yeah, I agree. That's just a massive move. Also, the other actually good trade we had on today was the Russell versus the S&Ps.
Russell's the strongest of the group.
Yeah, Russell's the strongest of the group.
Speaking.
But yeah, I'm going to take home just a couple of, not a crazy amount of short delta, but I am not going to make the mistake that we made when the VIX kind of explodes and you don't have any bullets or anything. I will not make that mistake tonight. I'm going to go home with some bullet.
You know, I didn't get hurt to the downside today.
Don't pay attention to all those things. Those are just a roll. Yeah. You didn't get hurt to the downside?
I didn't get hurt to the downside. Actually, I heard on stocks to the upside. Nvidia up $3 and change. Baidu up $4 and change. Lulu up almost $3. Those are the stocks that hurt me.
I only got hurt on premium.
Well, it went the wrong direction in expanding premium. Yeah.
Yeah, right. I mean,
I'm not short Delta in them. Matter of fact, I'm flat them, but I got hurt to the upside.
Yeah, the only thing that hurt us today was short vol, and I guess if you had some crude oil stocks that you were short some calls in, those probably kind of exploded today.
Sure.
But yeah. Other than that, everything went pretty good. It's just vol expansion. Most premium sellers, when you get vol, like I have no deltas in like Coinbase, but they exploded vol in there today. I have no deltas in Boeing, but they exploded vol in there today. And when you get that kind of like vol explosion, there's not much you can do.
And it hasn't backed off at all today. It really hasn't.
Not even for a brief second.
No.
Literally not for a second.
Correct.
Yeah, and just putting some crazy orders in. All right, so let's make the call for tomorrow.
Oof. Call for tomorrow with the evening S&Ps down 52. There's no way we open higher tonight. We probably trend lower for most of the night. That would be my guess, because obviously I don't have a crystal ball, nor does anybody else. I think we see a little bit more weakness, Thomas. Weakness into tomorrow too.
I think given this move in volatility, and this is a weird close here because they just rallied them 10 handles.
From down 60 to down 50. Yep.
From down 60 to down 50 when they're just pumping up vol at the same time. Awfully strange close.
Awfully suspicious.
Awfully suspicious. When you see this kind of thing. But oh, look at that.
Oh, 750, little scalpy on your one day, which was really just a 9-minute trade.
I'll take it.
You turned a one-day trade into a 9-minute trade. How do you do it?
70 cents in 9 minutes. That's pretty good.
Better than you could do, for sure.
Selling some bond puts here on the close. Just a couple.
More.
Just a couple more. Getting off the highs of the day at 143 and 144. Not going to go crazy, though. We made about 70 trades today. It was a little on the slow side.
Mm-hmm. Yeah, a lot of them made in the afternoon or close to the afternoon.
Yeah, I thought it was just, I struggled to find stuff to do, in the middle of the day. The rally on the close.
You care about Pepsi for earnings?
I do. I've never actually never looked at Pepsi.
I don't either, but I just thought
3.6 million shares traded. It's 3.6 million shares traded. It's got a 73 IV rank. It has an
which isn't bad, but it only has a monthly implied volatility of 22. So now you can find better.
It has an expected move of very small. Let's see, less than $5 on $167 stock. It has like a 2.5 or 3% implied move. I find those personally.
You don't even get out of bed for less than 5, for more than 5%, not 2.5%. Forget about it.
I find moves of 3% in that range or less or more by a little bit extremely difficult for earnings plays. Pepsi.
You gotta be directional, if anything, sure.
Yeah, I mean, if you're bullish in Pepsi and you want to sell, I don't know, some 155. I guess you could sell the 155 puts, 98 or 99 cents if you're really bullish in there. But I don't think I would sell calls and puts The only strangle that even comes close to being interesting is the 155. I don't know, 180. No, there's not enough juice in there.
You can't.
Yeah, I mean Pepsi's trading like it's going to move $1.50 on earnings, which maybe it will, but it's not that interesting to me. And I still don't even understand this boo rally on the close of just rallying. You know, they just took about 15 handles. That's a pretty big move. To me, what that means is that a lot of day traders were short. They were watching vol. Everybody got short. Didn't get paid at the end of the day. Had to cover with 5 minutes to go.
Sounds good. Good.
How
good
much of the S&P option business and S&P futures business do you think is professional business? So when you say
probably 60%,
when you say 1,000 contracts traded in the S&Ps, you say 100,000 contracts traded in the S&P options, even though it's not, it's more than that. But let's just say, what percentage do you think, minimum percentage, is kind of professional?
60%. How many times I gotta say? What do I stutter?
Well, I was trying to give you a chance to get closer to the right answer.
What? It's higher.
Yes. It's in the low 80s. I was really surprised by that.
I wouldn't have thought that. I maybe go up to 70, but
yeah,
that's a staggering number. I'm surprised.
I know.
When you were in the pit, you wouldn't trade with another professional trader if your life depended on it.
I know, because I was too good. But I was surprised when I was told that number on the future side, because the option side is not like that on retail, on most listed options, equity options.
Yeah.
In the indexes, it's closer to that number. But I was surprised by the amount of like professional to professional and high frequency firm to high frequency firm, that kind of thing. Over 80%.
Well, Saj, you know what else you're gonna be surprised by? These three guys. That's right. Christopher, Dylan, and Ilya. How are you?
Oh, the dream team is
Happy
back.
Monday, gentlemen.
Market's trading me fine, but I got Tom on my back like a albatross.
This guy. You can't get to break with this guy, Tony. I don't know how you do it.
I don't know how I do it either, Dylan. Thank God you're on my side again. I hated you not being on my side.
I'm with you now. I was thinking about it over the weekend.
I'm so happy. I'm so happy.
I don't know how you do it.
That's a snazzy, tasty effects shirt too.
Thank you very much. Appreciate it.
And this is how bad it is, Batista. So I finally, for the first time, probably really ever, have a proper studio with proper lights and a microphone. You see, and I go on Truth or Skepticism last week with Sosnoff, and he's like, "Oh God." He's like, now you're going full Milan. You're going to start trying to look good.
Yeah, I mean, like,
He's the only person that owns a financial network that gets irritated if things start to look a little too good.
I mean, Dylan comes on. He's got like a makeup artist, putting powder on his face. He's got like the lights are right. I'm used to him when he's like when his voice is breaking up and you can hear like trains going by.
In a hotel room in
trains going by in the background. Room service knocking on the door. All the crazy stuff.
Bring back belt cam Radigan.
Belt cam. I can't even get out of the horizontal position.
Yeah, where are you now? I'm on the side of the throughway.
That's happened. But now I've upgraded this beauty. I got multiple lights. I got a fancy microphone.
Nothing else. Doing it from the side of the beltway is a commitment to the quality of this show.
And he's just breaking my balls. I'm just trying to do what I can. Finally, he's like, "What is this?" So anyway, you have my sympathies.
Thank you, my man. You look handsome.
All right, so we'll start with you, Vecchio. What do you think here today? So I know Ilya is going to be a little puffy chested because this is kind of what we thought would happen last night. But what do you think here on this down move? Is it too early to buy him yet with this vol explosion today, or what?
Yeah, it's too early to buy them. Some of the short-term momentum is breaking again, and more importantly, we have the data in our pocket to tell us what's best to do here. And we're entering that zone with the VIX above 20 where it's not prudent to be directional. It's prudent just to be a vol seller at this point in time. If you look at the daily returns of being long ES versus, say, short strangles, you're going to see that you're going to get higher returns from being short the strangles with roughly the same volatility of those daily returns. So directionally, I don't think there's a bet either way right now. But this is a really bad week of the year. During the presidential cycles, the first 2 weeks of October are bad. And since 2004, we haven't had a green second week of October. So yeah, this seems like a period where the market might be a little soft, right for the taking.
Ilya?
I mean, I'm not mad at anything that's going on here today. It's working. Dollars are higher and stocks are lower, which is how I was positioned. What I'm looking at now is, I mean, if you didn't have shorts on before this, I wouldn't have them on now because we're at the bottom of the consolidation ranges for both ES and NQ. So I'm going to hold mine, but to initiate or to add, I'd let these levels get broken down if that's what's going to happen. And looking at the data this week, we're probably going to get more evidence that there's going to be fewer Fed rate cuts next year. That probably is higher yield still, and that's probably more sogginess from stocks as we go forward.
All right, that's cool. Dylan, last words?
I mean, listen, last words. Bring it, baby. This is the Super Glide is alive. Just ignore the. Let's go. I'm ready. This is going to be an incredible quarter. Everybody needs to calm down. I'm long the stock market, and I'm happy about it. I'm long the bond market. I'm not happy about it.
No, not happy about that.
But I'm not talking about that because you're not allowed to. I know what you tell. You said I'm only talking about losers. I'm supposed to just say, they're killing me in the bond market, Sosno. That's what I'm supposed to say.
Exactly. Now you're learning.
I'm learning. Listen, it's a slow process with me, but I'm getting there.
Have a good show, boys. We'll see ya.
Enjoy yourselves. Overtime right after this. Peace.
I'm running Snow Leopard with this. I'm a Mac. I'm a Mac. I'm a Mac. Gee. Multitask, MacBook handler, brother. iPhone in one hand, iPad in the other. Pop open top, Apple logo shining on the back. That's why all these player haters know that I'm the Mac. Easier to see a nun with VD than to see me ever typing on a PC. So if you got one, you can play a sad tune and play it back later in your room on your Zune. Windows made to break, and I'm here to crack it. And if I'm a Mac, that means that I'm immaculate. Style so clean, like it's disinfected. Clean surfaces where white light is reflected. Plastic case, Apple Store, keep my phone protected. Check my toolbar to see if networks are detected. Use my side swipe, applications hidden in it. This is Mac world, bitch, you're just living in it. I'm a Mac. 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 Roll into the coffee shop, know I'm on a power trip. Strapped with my laptop and my own power strip. Eye outlet, about to make your cable drop. Apple logo shining off the marble on the tabletop. So if you seen me, then you seen a star. Any place I sit down, call that the Genius Bar. Looks like I'm working hard, but to really know the truth, just taking pictures of my fine self in photo booth. Interface simple, why I need a Kindle. Working on that pad keeps my fingers mad nimble. So if you think I come up short, you must be wrong. More than one reason that these ladies call me Justin Long. I'm a Mac. I'm a Mac. I'm a Mac. Yeah, Justin Long, son. You catch that? Commodities as the toolbar. 10-hour battery life. Force. Quiz.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here. And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast. Option Trades Today. You listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bat.
Trading is hard enough. Here's what liquidity is. You want to be like water. Liquidity is in reference to how easily you can get in and out of a position, from volume to open interest to actual price at which you can buy or sell your position. It's important for all traders, from stock traders to futures traders to options traders or even crypto. Tight bid-ask spreads and high volume are characteristics of good liquidity.
Milton's bearing down and the Ayatollah awaits a response. It's Monday, October 7th, 2024. This is Overtime. I'm your host, Chris Vecchio. Joining us from Milan, Dylan Radigan, Ilya Spivak in San Francisco, and I suppose we'll give you my location too. I'm in New York. We're here for the rest of this hour as we get ready to wrap up the trading day as futures wind down their session. If you're joining us on YouTube, tell us what you're trading, what you think of today's action as we start off this trading week. Of course, come to tastylive.com, see what we're all about. Gentlemen, it was a day where stocks decided to take a turn lower as the session marched forward. All indications are that Israel will be attacking Iran tonight. I suppose that's the newsworthy event. A hurricane category 5, 6, bearing down on the west coast of Florida, and I don't even say that facetiously. Wind speeds have topped 175 miles per hour. As we look to the commodity markets, of course, oil continues to trek higher, but the idea that we may not be able to send any ships out to sea, hurting natural gas. We are awash in supply, of course, and there's a big reaction to the downside there related to Milton, which is pouring in. Ultimately, though, a day for the currency market, which perhaps catches some people by surprise. A Japanese yen is on top of the leaderboard, even with yields moving up and oil moving higher. Bonds continue to suffer, of course, along the way. Inflation expectations tick higher alongside oil. And that, gentlemen, sets the stage for this now second week here of October, which is typically a bad week of the year for stocks during presidential election years. As it were, we had some Fed speakers on the calendar today. They didn't do anything to help us out. But Ilya, I want to pick up the baton with a point that you left off at on last call. U.S. economic data hasn't been that bad. We haven't talked here on Overtime since the non-farm payrolls report was released on Friday. Is part of this move higher in bond yields, no more 50 basis point rate cut priced for November, 13% chance of no cut at all. Is this all related to the U.S. economy just improving?
There's absolutely no question about it in my mind. Take your cursor on the ES chart that we're hopefully showing here and put it on September the 18th. That's the Fed meeting. Now, consider what has happened beyond a 24-hour window of that meeting. Markets were circumspect at first. They got 1 day's rally. Since then, the S&P has gone absolutely nowhere, no place at all. It has made zero progress. Why? Look at what's been going on with yields. The markets have very clearly interpreted, even before last week's data, that what inflation will do is accelerate in the wake of the Fed being as dovish as they were. We've seen the curve steepen. We've seen gold go up. We've seen copper go up. We've seen all kinds of things occur. The dollar has strengthened, of all things, because all of this has been interpreted to mean that there will be fewer rate cuts downwind. And now we've seen quite a bit of help last week to this entire story. Not only did we have a very supportive U.S. jobs report, by the way, on multiple fronts. If you want to quibble with the frequent revisions in the actual non-farm payrolls data set, you can look at the unemployment rate, which unexpectedly fell to the lowest at 4 months. You can look at the fastest wage growth in 4 months, all of which is much less revised, much more anchored data, and say, well, the U.S. economy is doing well. On top of this, ISM services report is white hot, much stronger than expected on economic activity, and most importantly, on prices. And so you get this story very clearly of a Fed that's not going to be able to do everything the markets thought. We're now baked in for 130 basis points in cuts through the end of next year. That's down from 145, 150 last week, and 220 on Fed Day. So there's been a significant shifting of the landscape here, and the markets are very clearly saying, look, maybe we're not ready to sell off yet. The S&P 500 isn't falling. It's just stopped rising. NASDAQ has stopped rising. They're not declining, all of which is to say maybe that this is January again. In January, it took us about a month and a half to kind of come to the idea that losing rate cuts for good reasons is not a bad thing for stocks. Maybe that's where we are now. We'll see. Back then, the cuts were still somewhere in the future. Here, they're already occurring. So we'll see if that's different. But we are probably going to get data this week that gives us more evidence that there's going to be fewer cuts if CPI is stuck, especially at the core. So we're looking at really a decision point here. Either stocks are going to break down, or they're going to have to do some more idling until they figure out what all is going on, and whether this is more like January or more like the preceding episodes where less easing meant risk off.
Well, and the repricing of those rate cut odds in the last few days has been obviously very violent here, but there is also the perspective that outside of this geopolitical risk, stocks have been holding up in the face of all of it. We've seen the S&P and NASDAQ obviously have a bigger decline today, but that technical damage hasn't come into place. How are you weighing the considerations of escalation, Dylan, at least from the risk-taking perspective? Forget oil and looking to fade the geopolitics of it all. But how is what's happening globally right now playing into your decision-making for how you're approaching equity markets as vol starts to swell?
I mean, I just think you have to be up to. I think all of it's opportunity right now. You have to look at what actually is happening. The U.S. economy is resilient, robust, and healthy. There's no world where that's bad, even if it's bad for a moment relative to pricing. I understand that there's amplified, perceived, enhanced sort of inflation issues. I understand that it's a little bit hysterical in the Middle East. The bottom line is the jobs market is really strong. The economy is not going into recession. And 2025 is going to be a robust economic year. So I suppose the one thing that would give me any pause would be, well, you know, is there some sort of an inflation snapback, like a double dip or some sort of, I don't know what the metaphor would be, but it's like you think you've recovered from the flu and then all of a sudden you're back on you're laid out a second time. And so, you know, that's sort of the obvious risk. And I'm sure that's also why the markets, you're seeing the bond market do what it's, you're seeing some of the markets already saying that that's the point of concern. I don't know how to assess that. I mean, it's more a question that I would ask both of you and you, Ilya. What is where is the evidence of? I understand the cause for concern of a resurgence in inflation, but where is the evidence of it? Other than
in the steepening of the yield curve, in the rise of inflation hedges. No, I was just going to say, I understand the bond market is saying we're afraid it's coming.
Right. Obviously, the bond market is screaming like, "Are you kidding me? Like, what are you?" Like, I get that, but I'm saying outside of the bond market's anticipation for it, which is stark and very objective, does it actually exist anywhere else that's observable? Yes.
So far, the ISM data for the service sector, which accounts for about 80%, give or take, of the U.S. economy, is the place where it is most overtly seen. That was data that was released last week. And not surprisingly, the manufacturing side of it was still soggy, although less soggy than it has been for a while. We talked about quite a few of the green shoots in that data, despite a kind of weakish headline number. But the service sector, which is a much bigger part of the overall economy, that's really where you got a lot more vigor. So the overall thing, obviously, much stronger, fastest economic activity in quite a while. But on the inflation front specifically, September saw the largest increase in the inflation component of ISM since January of this year. And that's a lot, considering this is the service sector. This is the last bit of inflation that the Fed is fighting. And it doesn't augur well for what we're going to see in CPI data this week, which would be the next kind of most eye-catching, most significant bit of evidence.
The inflation expectations are moving up across the board. Oil prices and treasury yields are moving in lockstep again, which isn't a surprise. We're not quite in the danger zone for oil prices yet, but clearly having an impact when they are dislodged so quickly. Fascinating. When you look at the most recent CFTC COT report, bless you, we find that there hasn't been a swell in positioning. The Z-score is still negative 1.349. Last week it was negative 1.35. The week prior it was negative 1.37. This is still a market that has not seen the longs return into it in a big rush here right now. It feels like a lot of it is just short-term hedging for the geopolitical risk that's out there, not necessarily a belief that there's going to be a big boost in demand moving forward to actually substantiate the rise in the price of oil. And I bring that up because of something that I saw over the weekend. This, to me, was perhaps the most interesting thing that I saw over the weekend as it pertains to financial markets. Lingling Wei, if I'm pronouncing that correctly, the Wall Street Journal's chief China correspondent, tweeted out, quote, "A source in Beijing told me there are lots of, quote, misunderstandings in the market, unquote, about what China will do next to support growth. Yes, some fiscal measures, quote, in the pipeline, unquote, but nothing as big as some had speculated." So the speculation really begins the week after the Fed, right? September 18th, the Fed meets. September 24th is when we have the market exploding out of the gate with the Chinese stimulus efforts here. Crude oil prices, I bring that up because crude oil prices, September 24th, they peaked that day and began to turn lower. The market was giving you a very clear read-through that if this was anything to do with a China demand story, the supply side efforts that were initially announced wouldn't necessarily cater to boosting aggregate demand, at least sufficiently enough to stoke speculation in global energy markets. On the morning of October 1st, so a week ago last Tuesday, oil was trading down at $66.33 a barrel. We can make all sorts of arguments about the U.S. economy being stronger than most people feel, and that's a flag I've been waving all year long for 2 years now, quite frankly. But Dylan, this is an 87.5 IVR. This is feeling quintessential. Yeah, this feels quintessential. We have to, I've been net long deltas because of the short put spreads put on in September, but this feels quintessential fade the geopolitics risk at this point in time now.
Couldn't agree more.
What,
and again, I just think that the call spread. I mean, I think the only question is setting your strikes and picking your timing, because obviously this thing's it's wild and woolly over there, and it's not going to stop. But I also don't think it's going to disrupt the flow of oil, and so it's really just a matter of. But to the Ilya's point, when we talked about this last week, the Ukraine war didn't disrupt the flow of oil, but it still sent oil prices into a super spin for months, not even weeks. And so the only risk is that you get a real oil price spin just on because they can, basically. But I don't see it. I don't see how you could not be short this somehow. You just have to do. I'm interested. I think it's a worthwhile discussion to frame how to manage the risk and easing into it.
Yeah, I mean, I think that's really the biggest question for me, because what we did see, and this is certainly the case, that U.S. economic data is better, and whatever you think about the geopolitics, I think we all agree on that score. Crude oil would be rallying if there was a view that the U.S. economy is going to perform faster than expected. Now, granted, a lot of that faster isn't coming from the manufacturing side. It's coming from the services side. But that shouldn't tell us that energy consumption is not something that should be buoyed by that activity, because of course it is. And so when we look at this, it's a really important question here. How much of this is in fact geopolitics, and how much of it is the U.S. economy actually putting up a better demand outlook? So this is, I think, Chris, the line you just put across the chart right under 78 is exactly the level I'm watching here. If this is resistance, we're going to meet some kind of a wall there. The price action is going to fumble, and we'll see. And if there is some evidence that we're turning over, that would suggest, especially if it comes in the wake of US CPI being warmish, US consumer confidence at the end of the week being warmish, FOMC minutes giving us a sense that the Fed is not nearly as runaway dovish as people thought. If we got all of that in the background, telling us nobody thinks at the Fed that the U.S. economy is falling apart, and the evidence doesn't suggest it. If you break through that level, that might very well be a demand-founded thing. Whereas if you round the top there, that would suggest that it's not demand, it's still geopolitics, because the evidence on the U.S. economy is not debatable. It's out. The geopolitics is a flimsier sort of thing. So if oil can't rally despite upbeat U.S. economic news, well, that would be very clear that the geopolitics are fading, and I would be right on this boat. I just have to see some evidence that a top is actually starting to take shape, because here, all we have is momentum.
Guys, it's been a year since Hamas attacked Israel. When we woke up on the morning of... A year today. We woke up, when markets woke up on the evening of October 9th, I suppose the morning of October 9th for the first time, our opening quotes are $75.50. We had closed the previous session at $74.27. That started a trek higher where we ultimately peaked out at $79.75 in later October before trading sideways and choppy for the next few months. So for all intents and purposes, we're only up about $2, $1.50 from where we were when the events of the last year started to spiral and transpire. Did we just learn an important lesson about the oil markets? And I think, Dylan, you're going to say yes to this, but has the last year, what has been the biggest lesson that you've learned about trading around geopolitical events in the last year? Because we've had so many headlines that have been so actionable in recent months. Is it just get long gold? Is it sell oil vol? Is it buy dips in stocks? Dylan, what's the number one lesson that you've learned?
I mean, well, but it's interesting because it's sort of a setup because obviously I'm going to say sell oil on rallies, but when you look at even like this current situation and with the increased magnitude of the activity in the Middle East, not to mention Ilya's point about underlying economic activity implying strength, I do every time wonder, maybe this time is, maybe this time I always have a certain amount of self-doubt. And especially with the stakes being as high as they are in the Middle East with nuclear weapons and all the rest of it. But with all that's just me sort of couching the lesson, which is you sell oil on rallies. You just do. But that's easier said than done because, I bought my first set of puts, they're well below, when we were up half as much. So, doing it and doing it at the right time at the right price are two very different things. Gold is the most elusive to me in terms of having any kind of point of view of consequence. I try to listen more than talk when gold comes up as a topic. But oil, I felt very confident and felt, even if my timing is wrong, that it's reliable enough that you can roll it or, reset your strikes and still have it work out. And so for sure that's been the one, other than the fact that you do have to wonder about just being long stocks.
Ilya, oil prices traded below where they were last October 7th. Gold prices have never, not since then.
Right.
Once we got through that weekend last year, gold prices gapped higher and they have not retested the levels that we saw prior to October 7th. Everyone would look to oil as the key indicator here for geopolitical stress, for whatever shape the world is in, whatever shape the flows of liquidity are moving. Has gold been a better indicator for geopolitical stress over the past year than oil, or is there a different asset that you'd look to? And I realize in the context of saying all this, like so much more terrible things have happened since October 7th last year. And we're not trying to diminish what occurred, but this is a trading show. And so lessons learned during a geopolitical time perhaps help inform us to protect our capital and figure out how to optimize our portfolio allocation the next time we go through something like this.
Right. And I'm sure, we don't mean to say that more terrible things have happened in comparison. We mean other terrible things have happened since.
And will happen. And
will happen. Because we're in a world now that's less globalized by the day, that's more adversarial by the day, and that's probably not something that's going away. We're, as we've argued many times on this show, that's probably a big systemic shift of the previous 40 years being a kind of outlier of human history as opposed to the norm. So when we look at gold, I think it's very difficult to unpick which part of this rally has to do with China and the very rapid speed at which it was accumulating gold reserves last year and going into the front part of this year, at least. I think it's very difficult to unpick the influence of increasingly dovish Fed policy expectations, especially recently, especially in the second half of the year from what's going on here. We can clearly see gold did next to nothing in the second quarter going into mid-year. That gray box you see on the screen here shows you that really there was nothing there that was happening, despite the situation, for example, in the Middle East, and certainly also in Ukraine, not getting any better. I think the lesson to trading geopolitics from all of this is not to look at this asset or that asset. It's to ignore the headlines and look at real data. Look at the market. If you were to look at the spread, as we've done many times here, between WTI and the UK oil benchmark, the European oil benchmark, Brent crude, you would see there is no supply disruption, because you would see the markets telling you that the cost of European crude, the thing impacted most by what's going on in the Persian Gulf, by what's going on with Russia and Ukraine, the price of that would be soaring relative to very abundant U.S. crude if there was a disruptive story either there or there. It's not. It's falling. It's actually under its historical average. It's at $3 and change now, and the historical average is $5. So you didn't need headlines. You could wholly ignore, from a trading perspective, this or that person saying, oh, blah, 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 Middle East, blah, 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 Ukraine. The markets would tell you if there was an issue. If there's no issue, fade it when the markets have a bug out on a day or two or a week or two. But if there is a real issue, then you have to take those things seriously. And the price action will let you see that. You don't have to listen to anybody's opinion.
I think one of the lessons learned is that these geopolitics tend to have the biggest impact when sentiment is already moving in a negative direction, right?
It's the Italian elections indicator.
Last October, stocks were already starting to pull back. The second half of September, we saw rates bumping up because the Fed had told us, hey, we may not be done yet. And then the market does the heavy lift of raising rates by 50 basis points across the curve. And by the time you get to November 1st, the Fed turns around and says, no, we're done. We don't need to do it anymore. Thanks for doing our job for us. But in that period when sentiment was soft, right, that the Fed might need to do more, and we had the geopolitics in there, that's when it had the biggest negative impact on equity markets. We saw the same thing in April. Like, yeah, the tensions are ratcheting up again. Iran shoots missiles at Israel, but it occurs in the context of, hey, will the Fed need a hike again this year? And so now we have these geopolitics arriving at a similar crossroads, where when you look to the CME FedWatch tool, we've gone from a 50% chance of a 50 basis point rate cut to now where there's a 13% chance of no cut at all in November. The market's saying, did the Fed make a mistake when we started cutting? So this is the fertile period of time where if you're an equity market trader, negative geopolitics can actually weigh more and more. And you see it over the course of today where vol's ticking up around some of these headlines coming out of the Middle East, and stocks are having difficulty weathering that storm as the session goes on. People just begin to de-risk a little bit more and more and more. Now, I don't look at this chart and see any significant technical breakdown yet. If you didn't hate it on Thursday going into Friday, we are at the same exact levels. We're still above the 1 month moving average. We're still above the September 3rd high. It's a 44.6 IBR. So if you're bearish, you actually can perhaps sell some call spreads above recent highs to articulate that view, but want to wait, get down below 57.33.5 to do so. Just another 12 points between friends for confirmation. If you're bullish, this doesn't seem like an opportune time to sell puts just yet. Maybe if you want to get long MES against last week's lows and be ruthlessly efficient about cutting your losses below there, you could take a stab. But at a 44.6 IBR, this is a vol selling area. The VIX is in a territory where right now at 22.64, this is just the place where you got to be directionally neutral if you're laying out new capital for a position. And this is a week where the market tends to be a little bit soft by historical standards. So expecting a little bit of downside, vol expansion. Maybe we can get something moving on the long side once again if there's a little bit of a flush. So, Ilya, let's go back to the night of April 18th. And let's go to, how should we do this? Let's go to USO.IVR for the night of April 18th this year. Okay. This was perhaps the tell. Let us go back far enough? Yes, I think it will. Okay. This was the tell. The night of the 18th, oil vol, this is the 8-hour time frame, while it started to tick up once the attacks happened, when Israel responded to Iran, oil vol started getting sucked out of the market. And And then you had the headlines coming out saying Israel's hit some things, but no casualties, nothing of significance. This is over. We're going to de-escalate now. Oil vol, I think, is the bell that you got to watch if you're trading around these events. If it pertains to geopolitics, if you're going to be a day trader or a swing trader, if you're going to be someone who says, I'm just worried about this, put some money into gold, set it aside. The floor keeps getting higher and higher and higher. Central bank buying, moving away from the dollar or the euro as a reserve currency, whatever narrative you want to support your gold longs, fine. But oil vol, in terms of it being a tradable event, when oil vol cracked on the 18th, that is when everything started to turn. That's when equity started to bottom. That's when gold started to peel off and lose its safe haven bid. Treasuries didn't see a significant move because we were relaxing the demand for safe havens even as oil was coming off. So net, you just got a lot of chop. But if I'm watching markets overnight, and there's high odds that we see something tonight, watching USO.IVR in the platform, watching OVX, if you can find oil volatility and up to date, watching wherever you can watch oil vol and seeing if you can watch it break down. And if it begins to break down aggressively, that is the trading environment where you say, okay, I can fade the move in the VIX. I can sell put spreads in ES against recent swing lows. I can get back on the NASDAQ long train, Dylan, right? That's the tell that we have to watch for in these next few days. Otherwise, I think you just got to be very cautious and wary of a market that, you know, a year out from this, we're still dealing with the long tail effects. And the story seems like it's far from being over.
I mean, where the credibility sort of goes away for me is the number of people saying the Fed is late, the Fed is late, the Fed is late was not a small number.
For sure.
In the sort of August, September. Then the Fed does what they do, and there's a moment where we're like, oh, this is perfect, they're perfect, this is great, thank God they did 50. Then there's a jobs number, and all of a sudden the Fed is too much, too
early.
Soon, too early, too early, too early. All of which sort of accumulates for me to the diminished credibility of them collectively, to going to your joke last week about who they may be. And so, you know, the only thing you're left with is to sound a little bit like Ilya, is the data. And the data is a strong economy. And the data is going to be, I think, probably better than expected third quarter earnings starting in a couple of weeks. And so the only challenge that the market faces right now is whether or not inflation actually is preparing to reignite. Because I just don't see how you can relate to this financial market, whether it's on the currency side, bond side, the equity side, index side, individual names, whatever, but through the lens of stronger than expected and good momentum going into the first quarter of 2025.
Well, I think that's exactly the main kind of thought process that we've seen work out in markets really, well, I mean, for what, 3 weeks now, 4, that indeed what the Fed has done will bring another inflation scare, and that sort of the ghost of Paul Volcker will be resurrected. I mean, everybody likes to forget that, yeah, Volcker killed inflation or helped kill it with very aggressive rate hikes, but they came in 2 phases. He initially hiked, thought that it was over, started to go the other way, and had to hike harder and faster in a second round of tightening because the bogey got away. And I think that the concern is, well, this is not a time where you want the screws tightened. This is not a time where you want the Fed to suddenly end up with egg on its face the way it did with inflation being a transitory thing. You don't want them to make the same mistake again, because whereas then you at least had a coordinated response post-COVID from at least Europe also. They also dumped a ton of stimulus on their economy. They were also experiencing strong growth, hence their inflation issues in 2020, in 2021 in particular. This time around, the U.S. is the only growth game in town. The China situation is cute and all, but besides the comments that Chris just relayed for us about even internal skepticism about this stimulus, you can see the skepticism again in markets. You don't need anyone's opinion. If the markets were buying the China stimulus story, copper and the Aussie dollar and emerging market shares outside of China would be soaring. It would not be just mainland stocks, which can be mandated higher by Xi Jinping. So you don't have the confidence that it's going to work. And an analysis from The Economist this week says that China is about to spend at best about 1.5% of GDP, whereas most economists think they need about 4% to really kickstart this economy. So what then happens if the Fed has to clamp down because it got it wrong? There is no growth in Europe. China is suspect. And if you start to over-tighten on the U.S. because you've missed the boat in the wrong direction, well, then where's the growth supposed to come from? So there's all kinds of reasons to be concerned here, maybe. But again, you need to see it in the price action. I agree with Dylan completely that the fear now is reflation and a Fed that looks like it got it wrong, because the consequences could be all kinds of negativity from all kinds of different angles, not the least of which
but the market's wrong here.
Costs.
The market's wrong here, right? Like,
Why?
let's go to brass tacks here. There is a 0% chance that the Federal Reserve backtracks and doesn't cut rates the meeting after it started its rate cut cycle. There's a 0% chance. Okay,
I agree with you.
So let's go to September.
The market doesn't think that they're going to stop either.
Market is pricing a 13% chance that the Fed is not cutting in November. That is absolutely wrong. The Fed is 100% cutting in September, which is why I think there's a story here. Because if we take a look at the oil market, which we will, let's note the CPI trackers here. CPI, headline CPI, is due to take a little lurch higher from the September to October readings, but not core CPI. Why? Because this has energy in it. This has energy in it. Core CPI does not. So let's go to the bond market here, and let's look at this month of September so far.
It's a repeat. It's expected to be essentially a repeat of August. In August, what you got was stasis at the core and disinflation at the headline because energy fell a bunch.
Yeah, but it's all oil. That's the point.
Right.
The entire shift, the entire shift that we're seeing in Fed rate cut expectations is purely because of what's happening in the energy market here. The blue line is CL. The yellow line here is ZN, flipped upside down, obviously. That looks like it's pretty tight for the sake of doing the numbers here. The rolling 5-day correlation between ZN and CL is negative 0.94. The negative
5 days, but what about a 3-week correlation?
21. The 1-month correlation is now negative 0.72. A month ago, at the start of September, right? Just benchmarking it to see where this is all gone. So we'll go to September 6th, or we can go to the corresponding September 9th. September 9th, the correlation, 21 days, was actually a little bit stronger. Let's go to where we were at the start of October. This is perhaps the better way to exemplify this. October 1st, once oil starts exploding higher on the Biden headline news that Iran is going to attack Israel, the rolling 5-day correlation at that point was plus 0.33, and the rolling 1-month correlation was negative 0.21. So those have both strengthened from plus 0.3 to negative 0.95 and negative 0. Down to negative 0.71 on the rolling 1 month. So the point is that I'm getting at, in a very terrible explanation, is that the short-term correlations between oil and bonds have tightened, where oil is the reason. Correlation's not causation, but we kind of know how these things work in these relationships. Oil is the reason why bond yields have gone up. Oil is the reason why the market is not pricing in a 25 basis point cut. And absent the expectation of an increase in oil prices to the degree that we've seen, the rates market wouldn't be telling us that there's a possibility that the Fed doesn't cut again in November, which informs me of one thing only. Not only when oil comes off the board, when these geopolitics reverse, bonds are going to be primed to stage a very meaningful rally here off of these lows. That's the read through. That bonds could be in for a turnaround as well.
I can't buy that simply because we saw the yield curve steepening and gold rallying in anticipation of the Fed policy announcement before the announcement was even made. We've seen the reflation trade show up in markets as disparate as currencies and bonds from early September. It's just certainly amplified by oil now that it's decided to wake up, but oil was falling in all of this time. And you can see it on the very chart that you see here. Oil is not going up in the same spot here where you have the bottom in your yellow line there, ZB. It's going down. So the most recent moves, sure, yes, but that's way after the markets begin to reprice for a reflationary move. So yes, it's an amplifier without question. But that's the reason that bond yields are at the long end? I can't see that. It's a reason that they're as high as they are, but it's not the reason the curve is steepening.
Oh, well, the curve would be steep. The curve isn't steeper today. The curve is flattened out.
Today, yes. Look at the curve since the beginning of September.
Yeah, but today the curve went back into inversion territory briefly. So like all that steepening was erased. It all disappeared for a moment today. It was crazy.
A moment.
Yeah, but that curve is much steeper.
The curve is much steeper now.
I think of those who buy the bond now will be happy later. I'm with Vecchio. I think that this whole thing is some
the
sort
curve
of
right now is at
mental illness. I think
there's
evidence
4
of mental illness.
basis points. At the beginning of September, the curve was a negative still. So it's a completely different story. And it's the front end that's screaming now. You can't disentangle expectations for a dovish Fed rate cut cycle from the shifting in inflation expectations that happens 3 weeks before oil decides to roll out of bed. It's just not lining up at all.
But there are lagged and variable impacts of these things, my friend. I see the 210 spread.
Well, it has to occur in order for there to be a lag. Oil was falling at that time.
22.9 basis points is the high for the spread on September 25th. And we're only at, again, depending upon where you're looking, I have it as 3.3 basis points here. If you're using continuous or not, forget all that. Let's just say it's 3 or 4 basis points still. That's a collapse of 16, 17, 18 basis points from the highs in the past 2 weeks. And that's, there has been something that went on with the market. Maybe it was China being
and it's because the front end has been rallying.
The front end is going to be front end rallying. The front end is down from 104 to 103.
Yields have been going up at the front end.
Oh, well, yeah, because now the market is saying that the Fed isn't going to cut or isn't going to be able to cut again in November.
I'm not saying the rise in oil has not pushed up inflation expectations. I'm saying to say that is the reason why we have dilution of Fed rate cut odds, and that's it. Misses the preceding 3 weeks of evidence.
Oh, no. It's not of course it's not the only thing, but I would make a strong argument that the last leg that we've seen
I would agree with you. I would agree with you completely. As an amplifying force, of course, no question.
We have to. This is what I want to get at. Like, if we pull on the string, then if oil's coming in And there's been this tight correlation between oil and the rates market and bonds right now in terms of pricing for November. Then one would surmise that once oil comes off the board, bonds are going to stage a nice little rebound here, not necessarily in the short term as
If
the haven demand
oil
comes
comes
down.
off the board.
Well, yeah, that is like the whole base theory of this premise. Like, assuming
Because if
oil
this
comes
is
off the
about
board,
demand.
no, it's not about demand. It's about, in the event that oil comes off the board because of geopolitics, bonds will ultimately be positioned to start their climb once again, because some of the contributing factors to their demise recently, this swelling of inflation expectations, they're going to be removed. And the removal of those pressures, right. And as we saw in April, April there was a back and forth. So I'm trying to shape up the expectation that if you want to lay in long bonds, we go back to continuous here. After April 19th, ZN didn't rebound right away. ZN actually spent some time churning sideways once the geopolitics came out of the market, and then it was able to start moving up. So that would lead me to the conclusion that given the swell that we have in volatility in ZN at 43.1, we are in the place where you can start looking to sell the vol in bonds too, whereas the last several sessions, it just still didn't really make all that much sense. You can start to feel a little bit more confident down here that you're reaching a point where unless oil goes up to 80, vol may be getting a near-term cresting point. It's going to have to get a lot worse for things to go further south.
I guess the essence, I don't disagree with any of that in principle. The essence, I guess, of my disagreement with where this is steering is there is no knowing that the rally in oil is solely geopolitics or even mainly geopolitics, given how U.S. economic data has performed over the past week, and given that oil has ignored geopolitics until the data has become this good. That there is no way to say that this data is not motivating an upswell in oil demand expectations, in which case it will not be easy to come off, even if the geopolitics let loose. So there's a lot of ifs in all of this in order for it to be actionable in my mind. You can't assume that you're a buyer of bonds on the premise that oil will turn, because oil hasn't turned and we don't know that it necessarily will. So therein is the interesting thing.
Ilya, okay, let's say I accept everything you're saying.
Right.
How can I live in a world where there's any probability that the Fed stops cutting rates at their next meeting?
I don't think you can. I don't think there's any serious likelihood that they're going to.
But the market is asking me to believe that. The market
I don't think they are. I don't think they are.
Well,
I think what the market is asking,
they've introduced that mathematical possibility at a number larger than 10%.
Right.
Well, I think, well, of course, there's uncertainty in markets. There's always a degree of uncertainty in markets. Anytime the markets are telling you that they know for
markets is not the same. Uncertainty markets is not the same thing as a material possibility that
10%. I wouldn't say is a material.
Context is needed here. Lawyer will tell you 5% is a material probability.
Time out. A week ago, the scoreboard for the CME Fed Watch tool was 0% chance of a hold. A 25 basis point rate cut was fully priced in. Right. Additionally, there was a 34.7% chance of a 50 basis point cut.
Right.
Today, there's now a 0% chance of a 50 basis point cut.
Right.
25 is no longer fully priced in. And the market's giving you a 15.5% chance of a cut. So if you told me a week ago, what are the likely outcomes, Chris? The market was saying, base case scenario is that we're cutting rates, but if they don't cut rates by 25, that means they're probably going 50. And now we've swung to the other direction, which is to say, like, well, yeah, they're probably cutting 25, but if they don't, they're probably not cutting at all. And that's
early October. And there's an election in the way before this Fed meeting. These numbers mean very little here.
Dalen's asking the question, in what world should we be entertaining that there is anything more than a 0.1% chance that the Fed cuts rates next month?
I think there is a 0% chance.
So then we should fade this weakness in bonds.
If anybody is seriously considering that there is any chance at all that the Fed doesn't cut in November, these things are going to have to hold up more durably.
But I guess what I'm
for
getting
a week, let's say.
But again,
right now, I'm not taking it seriously.
But the bond market's taking it seriously, and I feel like that could be an opportunity.
I certainly think, for example, if you look at ZB, which looks a lot like SR3 here, interestingly, you could be looking at a near-term point of support. You could see a bounce. CPI that isn't awful this week, that suggests the Fed is still on course, might help you do that. Sure. Is it good for any more than a day or two? I don't know. It's unclear. My point isn't that you can't get a bounce in bonds here. My point is you don't know that you're going to. And until the price action tells you that it cares about all of this, there is no evidence to suggest that it does. And the markets, as we know, can go to price in all kinds of loony things for a while until they don't. So at the beginning of 2024, all of us were sitting here saying the markets think the Fed is going to cut rates 6 times in 2024. That's bonkers. And yet it endured for weeks and weeks and weeks. So the markets can say weird things, but that doesn't necessarily paint you one way or another until the price action confirms. Could we find support here? Yeah, sure. Have we? No.
In terms of sector shakeout, guys, we have 5 that are in the green for today. XOP, IYE, XLE, all those sound familiar because they're all oil-related names. None up by more than 0.62%. Metals and mining up by 0.2 themselves, and semis up by 0.16. Otherwise, it's a sea of red. Not terribly red, but it's red nonetheless. Worst performers, XLU. Utilities down by 2.3%. Retail off by 1.95, excuse me. Consumer discretionary up by 1.55. And then the gold miners, GDX, GDXJ, also off in that same neighborhood here. In terms of the bond calendar for the rest of this week, we do have auctions coming up to keep an eye on. Tomorrow, we're going to get a 3s auction. So if you want to look at the 2s, you want to look at the 5s, good luck, because there's no 3-year future. In any event, you could look to an ETF like SHI, for example, if that's the cut of your jib. But we have 3s tomorrow. We're going to have the 10-year note auction on Wednesday, 30-year bond auction on Thursday. I love the fact that we get a 10-year note auction on Wednesday afternoon after we get the CPI release. It's going to be a real quick temperature check to see how traders are feeling in the wake of that data. The data looks like it's going to be pretty good. And absent the rise in energy prices, it looks like it would still be good on the headline for October 2, based on what we've seen through all 7 days of this month so far. So not a ton behind us, but enough to start thinking about what those price pressures will look like. Other than that, guys, this week, besides CPI on Wednesday, what is the big event that you're looking forward to? Dylan, let's start with you here before Ilya has the final word. What is the most important thing that you're watching? Is it something in markets? Is it a data release?
No, I think it's a kickoff of third quarter earnings. I mean, it's still a week or two away, but I think
you're not coming through. You say the Mets-Philly series?
That's right. That's right. That's what I said. Did I miss? It came out different, but yes, yeah.
Sounded. I heard.
Although I'm actually rooting for the Dodgers. Well, how does it factor in that I'm rooting for the Dodgers?
Confusing.
Uh-oh.
That's some bad data. That's like a Fed rate hike.
That's right.
After a rate cut. That's what's happening, though. I'm a Dodgers fan, so you're gonna have to put that into your formulas.
That's unexpected. Outside of the sample pool that I have here. Okay, so
as you're representative of the San Francisco Giants, I have to take issue.
There's a offending a wide variety of people all at the same time. It's very efficient, actually.
Okay, so we have PepsiCo, Delta Airlines, Domino's Pizza, and JP Morgan this week. Which one do you care about the most?
JP
Morgan, Ilya. Which one do you care about the most?
I think it's going to have to be JP. I want to hear what they have to say, really. I'm not so much interested in the earnings. I'm looking at it as an indicator. Pepsi, I don't think, is enough of a marginal consumer indicator for me to think that that's going to be more interesting than the University of Michigan consumer confidence numbers. I think that's the more interesting consumer barometer this week. JP, because of what they might say on rates and banking margins and
the
refi risk and the election and all of that. Yeah.
I'm interested in watching DPZ, quite frankly, because I absolutely hate their pizza. Yes, I'm a pizza snob because I'm Italian American. And no, you're not allowed to put pineapple on top of it, so don't bring that heat over here. But DPZ has a 19.4% annualized return over the past decade, while the S&P 500 has managed a very meager 13.6%. Domino's Pizza is an incredibly well-run company. They've outpaced Berkshire Hathaway and Apple at stretches of time over the past decade, over the past 15 years since the global financial crisis. So it's a fascinating stock with some interesting insight into the health of the American consumer, or lack thereof. Dylan, with just a little bit more, we could start constructing our Forever America portfolio. Johnson & Johnson from birth. We'll get Domino's Pizza for the teen years. Altria from when they're stressed out from working. Ozempic to get rid of it all. We'll get Geo, some prison stocks in there for when they decide to bust out in their midlife crisis. And then I suppose we'll get some funeral homes as well. We'll get the entire American life cycle from cradle to grave. And Domino's Pizza would certainly
sounds like a great portfolio.
Yeah, it's the American, and now with Ozempic in there, add some Eli Lilly, Novo Nordisk. These people aren't going to die. They keep consuming. They keep smoking. It's a win-win for everyone. Shareholders benefit all along. Jokes aside, though, we're out of time here on Overtime. We'll be back tomorrow, same time, same place, every Monday through Thursday after last call, 4 p.m. Eastern, 3 Central, here on Tasty Live. For my friends, colleagues, Dylan Radigan, Ilya Spivak, I've been Chris Vecchio. We'll see everyone tomorrow. Good luck trading. Tasty Live at Night starts next with Ilya Spivak and Macro Money. See you soon.
See you there.
If you missed the live show, here's our cherry on top weekly recap.
We also went to Universal Studios, which was really fun in Hollywood. So we drove to LA with our rental car. You can't do that if you don't have a rental car, can you? No, you can't.
Drove from Vegas to LA.
Well, actually, my wife drove because I had food poisoning. So
I have heard it all. Heard it all. I am done. I am done here.
You live in Florida.
Yeah.
Don't they have Universal by Disney? I know they do.